rather than from the perspective of how much it changed the cost of transactions. The final reflection is that rushed policy processes provide limited time for proper data analysis, proper impact analysis, and consultation, and that these outcomes, kinds of taxes that pass as a result, are often heavily criticized, and changes are later needed. So a sort of more careful policy design approach might limit the negative effects that come later if you rush a measure through. Oh, and then just before, while I sort of close, my colleagues at the International Center for Tax and Development have produced a body of work on taxing DFS. So if you're interested in policy design and things that I wasn't going to get into in this talk about like models for taxing digital financial services, we do have some policy briefs on our website that I've put a screenshot here. Please feel very welcome to go and look at that. And we have some ideas of how this can be done better, and also reflections from other contexts, like I mentioned, with Ghana and Kenya and others. Okay, am I in time?
Yes.
All right, wonderful. Thank you very much for your attention.
Thank you very much, Adrian, once again. And next is Lorenzo. Lorenzo has 20 minutes to share with us a paper titled Back to Back, Bank to Bank, Digital Currency, Deposits, Substitution, and Credit. The floor is yours, Lorenzo. Thank you.
Thanks. Just be waiting for the slides. Okay, so this paper is co-authored with two economists at the Bank of Uganda, Jimmy Appa and Samuel Muzoke, and it's called Back to Bank, Digital Payments, Deposit Substitution, and Credit. So obviously the main object of this paper is mobile money. You know, it's a very widespread technology all over Africa. It's estimated that daily about $3.5 billion are exchanged with mobile money. There's a bunch of literature which, let's say, looks at mobile money from a perspective of risk sharing, saving, remittances, but there is a bit less regulation. What we are studying today is actually the digital money tax, the tax that was introduced in Uganda. And as you can see from a bunch of newspaper titles, actually this is a quite hot topic all across Africa. And obviously this theme has a bunch of related topics. In fact, there are governments who tend to introduce such a tax because they want to finance the rising national debt. They also want to formalize the informal economy. However, very little is known about who this tax is burdening and how this tax affects other payment systems. So the research question today is, do digital currency disintermediate banks? So I try to study it through the perspective of a credit market and through the perspective of financial inclusion. So what is this paper about? So in this paper, we have a very simple toy model of currency substitution, which I'm not presenting here for a matter of time. So we try to model a trade-off between conveniency of storage of money and transaction cost. It is based on identification, which takes as exogenous shock the unexpected introduction of a digital tax in Uganda, which happened in July 2019. And this was an unexpected shock, as most of you know, because this was not discussed publicly before being introduced. So the public sphere didn't know much about the introduction of this tax. What I use as heterogeneity is the geographical differences in access to the mobile money substitute. I will talk a bit more about this in the next slides. And what kind of innovations does this paper have? First of all, we provide evidence of substitution between bank deposits and digital currency. And actually, this is one of the first paper using detailed data on mobile money transactions. As final outcomes, we also try to understand what happens to the credit market when substitution between mobile money and other payment system happens. And so we try to identify a liquidity shock to banks, a positive liquidity shock to banks, which changes the credit provision of banks. So let's try to, we tried with my co-authors to formalize in a very simple way what's happening here. So let's suppose to be in the pre-policy period where everyone is using mobile money. So mobile money is mainly used for deposits and for payments. This remote is not really working. So but what happens? The tax is introduced, and since in Uganda, at least in 2018, POS, so possibility to pay with cards was not so spread out. The direct competitor for payments with respect to mobile money is cash. So people substitute mobile money with cash for payments. Now, moreover, there's a bunch of literature explaining that, let's say, stressing the fact that it is not safe to keep the money under the mattress. So it's a matter of deposit, where to store our own money. And while before we could do it with mobile money, with a tax, now it becomes more costly. And so people might switch to banks. Where should I? Now, the first question that might arise to you is, okay, so why did bank deposits never take up before? So actually banks were an option also before, why were not people using it? So we find the answer with a new digital financial innovation, which was actually already present in Uganda, but had never taken up before, which is called banking agents. I think most of you know what they are. So what we show actually is that there is an increase after the introduction of a tax, there is an increase in bank deposits, and this increase actually comes mainly from these banking agents, which are providers who are spread out through the territory and provide a service for the bank. And what we also show is differences, geographical differences in where these banks deposits grow the most. So these bank deposits actually grow the most where there were already a network of banks technology deployed, which we find in ATMs. So the possibility to withdraw money through ATMs. So practically, ATMs is a fast way to withdraw cash to make payments. So people make deposits through banking agents and then withdraw cash through ATMs to make payments. So in line with what Adrian was showing before, what we show here in this picture is the decrease in the mobile money account balance straight after the taxes. So we show that there is a decrease of about the equivalent of $80 million from mobile money bank accounts in the first quarter after the tax is introduced. The red line instead shows the deposits which are made through banking agents. And surprisingly, they start increasing straight after the tax. So obviously this is just suggesting evidence, this is not causal. Now we try to dig a bit into the empirical of a paper. So obviously there is a bunch of literature which tries to study the effects of digital currency and especially central bank digital currency on banks intermediation. What we provide here, our contribution is a sort of empirical evidence. Then there are a bunch of papers on mobile money and a few less on regulation. So our contribution is both on the regulation of mobile money, and we will see another paper later, and also from a data perspective, since we are one of the first to use administrative individual level data on mobile money. So as I was saying, our data comprises mobile money transactions. So we managed to collaborate with one of the two main providers in Uganda and get access to about 2 billion transactions in 2018. And for the 20 million users we managed to get access to, we managed also to get geolocation, so the place of residency of a random sample of 2 million users. Then we use data from the Uganda National Panel Survey to validate the findings we provide through the transaction level data. We have data on this new banking technology called banking agents, and in particular we have monthly data on deposits at district level. Then we have data from the bank's balance sheet, both monthly and quarterly for all banks in Uganda. And we also have access to a very cool data set, which is the credit registry of Uganda, and we have monthly data for about 2 million loans. And we have also individual characteristics on the borrowers, like location, demographics, credit history. Now, let's go into the identification scheme that we are using. As I was saying, we use as time variation the unexpected introduction of mobile money, and this induces a shift in technology from mobile money to banking agents. And what we use as heterogeneity is the geographical variation, so the presence of ATMs, which is a proxy for easiness of substitution of mobile money with other payment systems, and in particular bank-related technologies. So, this is not really working. Oh. At the end of the presentation, sorry, I don't know what happened. Do we have a mouse or something? Okay, sorry for that. So where were we? So we have actually different levels of variation. We use both user level variation, district level variation, and bank level variation, all at geographical level. Now, let's go on and let's go to the empirical analysis. So let's try to wrap up a bit what we think is the mechanism. So we have this mobile money tax, which induces an increase in the cost of mobile money. This induces a decrease in the usage of mobile money and triggers a shift in technology, which is shown by the increased adoption of a bank-related innovation, which is banking agents. What we show is that there is an increase in deposits, an increase in bank deposits, an increase in the usage of cash, and also an increase in ATM withdrawals. We also claim that this increase in deposits also induces a liquidity shock to bank, a positive liquidity shock to bank. And what we will show is that there is a higher deposits turnover, which leads to a decrease in the loan maturity of new credit. So for our empirical specification, we use a difference in difference design, which is defined by this equation. And we also use an event study specification. So again, the unit of analysis are either individuals, household, district, or banks. We include time and unit fixed effects. And as I was saying, we use as heterogeneous effect the presence of ATMs, as we use it as a proxy for substitutability of mobile money with other systems, and in particular bank-related systems. So first of all, we show that mobile money decreases. So we read all the results as the relative effects of the tax on places with high ATMs, high ATM density, with respect to places with low ATM density. So the first thing we provide, the first evidence we provide is that in places where substitutability of mobile money is easier, we register a decrease of almost 10% of mobile money usage. So here what I present is the event study with different type of mobile money usage. So both sending and receiving, deposits and withdrawals. This is backed also by the difference in difference design, which mimics the results. And what we do also, we do a similar test using the panel level data surveys from the Uganda panel surveys. And we provide very similar results on the probability of using mobile money after the tax is introduced. Then what we show is that there is an increase in the adoption of these bank-related technologies, or banking agents. So the first thing we show is that there is an increase in the total number of banking agents straight after the tax is introduced. And in particular, we show that on average in IATM districts, in districts with a high density of ATMs, we pass from about 2 banking agents to 120 in the 3 and 6 months after the tax. While for low density ATM districts, the increase is much lower. Similarly, we also use data at the bank level, at the bank level, and we have data on the number of agents at the bank level, and we also show that this happens also at the bank level. So not only geographical level, but also bank level. Those banks which are more present in high ATM density places and who have a high ATM density register an increase in the number of banking agents. Then we also show that there is an increase in deposits through these banking agents. So the first thing we show is that there is an increase in the inflow of deposits, of cash deposits through banking agents in places with high ATM density. And this is also backed by our event study approach. What we also do, we also show that there is an increase in the stock of deposits at the bank level. But what kind of deposits increase? So it is not the long-term deposits, but actually is the short-term deposits. And this is in line with our history, with our storyline of a high turnover of deposits. So what's happening is people substitute mobile money with cash. They use cash for payments, but they store it in banks through banking agents. So there is an increase in the inflow of deposits, but also an increase in the outflow of deposits. And we show this by showing that there is both an increase in the usage of cash in high ATM density district and an increase in the withdrawals of cash in places with high ATM density. And all these analyses are backed both by the difference in difference design and by the event study design. So just to wrap up what we have been saying so far. So the mobile money tax induces a drop in the mobile money usage and the adoption of banks' financial innovation, banking agents. So as we were saying, the bank's financial innovation facilitates a substitution of mobile money for bank deposits for storage and cash for payments. So what do banks experience? Banks experience a higher inflow of money through this new innovation, which is banking agents, and a higher outflow of money through ATMs for payments. So actually, there is new liquidity for banks, but it has a high turnover. So the high turnover of cash leads to an increase in the demand deposit stocks, and we show that also at the bank level we register an increase in the stock of deposits. And now we ask, how does the credit market change? What are the implications for a credit market? We use data from the credit registry. We use an established method from Quaggia and Milan to try to estimate the bank lending channel. And we try to study these on different outcomes for credit, which are the term of repayment, the total amount and the number of credit issued, and the cost of credit, so the interest rates. So what we're claiming is that banks face a new liquidity, but they change their liquidity management because of this high turnover of cash. And what we claim is that there is a transfer of rent from high to low risk borrowers. So we show the effects on different type of borrowers. We show the first table. So we differentiate between low and high risk borrowers with and without a credit history. So what we show, what we first show is that there is a general decrease in the term of repayments, so in the length of credit of new credit granted for all customers, and this is in line with a higher turnover of cash. What we also show is that there is an increase in the amount granted to low-risk borrowers with an established credit history, but also there is a decrease in the amount granted to high-risk borrowers without credit history. And eventually what we show is that there is an increase in the cost for credit for high-risk borrowers. And we see the increase in the second and the fourth column. So we wrap up the paper. So what we do, we study the effects of digital money tax in Uganda on substitution between mobile money, bank deposits, and cash. This is a very highly discussed policy in Africa. And to answer this question, we use the data on the almost universe of mobile money transactions in Uganda. What do we learn from our paper? First of all, digital currency crowd out bank deposits. So we show actually the contrary. We show that when the cost of digital currency increases, bank deposits replace digital currency. We also show that fintech monopoly prevents financial innovation, and this was the case of mobile money against banking agents. As soon as the cost of mobile money increases, banking agents increase their presence in Uganda. Moreover, we show that banks facing volatile liquidity, so high turnover of deposits, reduce their maturity at all level and transfer rent from high to low risk borrowers. So we hope we are contributing to the limited literature on financial regulation and regulation of mobile money. I hope you enjoyed the paper. Thanks a lot.
Thank you very much, Lorenzo. Our next presenter is Mr. Tasi Nyanagabo. It's going to be a virtual presentation, and the paper is titled Demand for Cash and Drivers of Digital Payments Adoption in Rwanda. Tasi, you have 25 minutes. Thank you.
Well, first of all, good morning, everyone. I hope Modibo. So thank you for having us and having our paper on the presentation for this great conference today. I couldn't be there physically because of some last-minute scheduling conflicts, but I'm looking forward to this presentation and the Q&A that will arise from the presentation. So without further ado, you can maybe confirm if the screen is visible and the slides are moving.
We
Hello?
can see it and we can hear you
Okay.
loud and clear, sir. Thank you.
Perfect, perfect. Great, thanks. So this is a paper authored with co-authors here. I'm an economist at the National Bank of Rwanda, as was presented earlier. And the paper was co-authored with colleagues here from the bank, Dr. Matthias, Dominique Nilskomavoko, and Dr. Thierry Kalisa. And of course, the usual disclaimer applies when it comes to the views being solely of the authors and not the bank. So we started by basically surveying the literature on what it says and what digital payments are. And basically, as was presented earlier, and as we basically understand, is that digital payments could represent any transfer of value between accounts using digital devices. And these range from mobile money, QR codes, payment instruments, to cards, credit, debit, and prepaid cards. And in general, digital payments are also a way to store value online and to transact this value online and to pay bills and to send and receive remittances and to pay for different services and goods that individuals require on a daily basis. And what we also see from the literature is that digital payments have an importance, or they've become important in society today. And what this author says is that they are important in terms of promoting financial inclusion, that they're more secure and convenient than cash. This is what some individuals report, although studies have something to say about this, and this is precisely what we investigate in our paper. And they also contribute to increasing accuracy and reducing transaction costs because of these convenience or this relative ability to facilitate transactions between individuals without necessitating the use of cash or carrying sums around. And lastly, and this is a point that I think will speak to people here, that they generate data for better analysis and for policy making. So the data that we used in this paper and previous authors used is data that is generated from these transactions taking place. And once these transactions take place, we're able to have sort of different data points that we can utilize to basically conduct analysis and different research. But the literature also says or identifies some key challenges associated to digital payments in general. And this paper from Zimmerman identifies challenges from the supply side and the demand side. So from the supply side, what we see is that there is fraud from unreliable systems that could arise from poor integration or poor setting up of systems related to digital payments. And there could also be a challenge of poor interoperability, how well the systems are able to be integrated across each other. So for instance, if there's mobile money payment channels, how are they well integrated with banking, regular banking, mobile money, regular banking transactions, I mean. So could there be systems of push and pull where individuals are able to get money from their accounts and use them through mobile payments directly without necessitating this other link? And there's also a general challenge, and this speaks to us in sub-Saharan Africa, as we'll probably get into later, that there's also a lack of infrastructure that could be challenging. We take it for granted, but when there's no electricity, when there's no available fiber, things that are basic infrastructure, maybe in the Western world and elsewhere, when we don't have these sort of things, it's difficult for actually digital payments to functions and to operate. And on the demand side, the authors also identified that could be challenges from the users, of course, low financial literacy, but also limited education on how to even use these products to begin with. So we start by looking at the evolution of digital payments by looking at access points in recent years. So different kinds of access points, you name it, ATMs, bank branches, mobile money, and other different retail agents. And in the paper, we start by looking at the global context using data from the IMF, this report on financial access. And what we see on the left-hand side is that, for one, we've seen an increase in access points in these particular 4 years that we've just gone through. But this increase in access points has been diverse depending on the region. And we highlight Sub-Saharan Africa in particular, where we have non-traditional access points. And these non-traditional access points are mainly mobile money agents. So we see that Sub-Saharan Africa has recorded a tremendous increase in mobile money agents compared to other regions globally. And this speaks to the uniqueness of Sub-Saharan Africa and the way that we've actually come to cope with the infrastructure that we have and how we were able to translate it into sort of unique products that are tailored to our economies. And this is what we see on the chart on the right-hand side. Here, we're looking at the number of these mobile payment accounts, or these mobile money outlets or access points in Sub-Saharan Africa by differentiating countries into upper middle income, lower middle income countries, and lower income countries. And what we've seen is that since the launch of these products, so that's the variable on the x-axis, since the launch of these products, we've seen the number of accounts increasing actually. So on the right-hand side, on the right axis, we have the number of accounts per adult, and we see that for countries like Rwanda and Uganda, we've actually we have as we speak, accounts that far exceed the adult population, where we have around 2.5 for Rwanda and around 2 for Uganda since we've launched mobile money payments. So this shows sort of mobile money, digital payment structure that we have today and how it looks and how it can be different from other countries. So if we sort of narrow it down to the national context, Rwanda in particular, because our paper was studying the case of Rwanda. The first thing that we can see is that under its NST1, or National Strategy for Transformation, which was the government national strategy from 2017, it had as key objective to increase the value of electronic payment transactions in Rwanda from 26% to 80% by 2024. So by 2023, this target had been surpassed. Value of electronic payments was actually around 199% of GDP as of March 2024. And this could be attributed to the government's efforts in prioritizing cashless economy, but also availing public services in digital ways. And this is what we try to sort of highlight in the introduction of the paper, where we show some of the innovations that government has put in place, but also private individuals enabled by this environment, or this business environment that is very conducive to fintech and electronic payments. And we highlight Momo, which is an MTN product, which is operating in other countries as well, but also this real-time payments clearing system, RIPS, that was launched in 2011, and Irembo in 2015, which is the government services platform for all public services actually now in Rwanda are used through this Irembo channel, where individuals can apply for the services, get different certifications. For instance, your birth certificate, you could get the birth certificate on Irembo in a matter of minutes, in a few clicks, but also the digitization of tax payments through the Revenue Authority. So tax payments are now also done in a digital way at a very large scale. So and this is spread across sectors, actually. It is across education, where we have systems that enable people to pay for school fees, like Urubuto. In trading, in commerce, we have Rwanda Mart, Soko Mall. We have Babel in health, which connects patients to doctors. And I believe most of these players are actually active across the region, not just in Rwanda, such as MTN and the Mokash, which can now in Rwanda provide credit up to 500,000 Rwandan francs to any individual that holds a SIM card and that has a credit reference that is okay and that has been a customer for a number of years. They can get up to 500,000 Rwandan francs, which is a bit more than $400 US dollars. And we also have these R-Switch system that connects interoperability across all these players, be it the banks, but also the mobile money agents. So the first point of the paper, one of the first things we did in the paper was to sort of earmark what we have so far and how digital payments have been evolving so far in Rwanda and well, the current products that are available on the market, and sort of provide these sort of stylized facts. So this has improved the overall digital payment system ecosystem, as I was saying, the operability between different agents, be it government itself through its provision of services, but also the businesses and in the end, individuals that are able to transact on a daily using digital payment systems. And this is why we've seen the share of e-payments ballooning in terms of the share of GDP from 0.3% in 2011 to now 199% in 2023 at the time of writing when we had all these data compiled on mobile payments. Now, what do we do in the paper? So having witnessed this digital transformation that the country has gone through, and having witnessed that the literature is also acknowledging this digital transformation, that we have studies that are looking into the drivers of digital transformation, what is behind this adoption. We noticed that these systems or these papers are focused on the drivers of the adoption itself, why individuals choose to use digital payments, but they're not documenting why individuals are actually using a specific digital payment to a given extent. So the intensity of adoption. So the intensity of adoption is the main objective the paper wanted to uncover here, which is what determines the extent to which one individual will use one form of digital payment over another. What are the key drivers that determine that? And this is where we aim to make our contribution specifically. So I will not dwell much on the literature. As I was highlighting, we've seen papers that were conducted on financial inclusion for one, but also the use of digital payments in the region, but also in Africa. One paper that is specifically interesting that I could highlight for Rwanda, which is sort of a paper we built on, is a paper from Maniriho and Munyegera, which are papers that directly show the drivers of adoption of digital payments in Rwanda. And these are such things as the wealth of the individuals adopting the digital wealth, the digital payments, the access to assets, but also the reliability of networks. So we were hoping to build on these findings and say, okay, once you have these drivers pushing people to adopt payment systems, which payment systems are now are they going to choose, and how are they going to choose one specific payment system over another, and what will be the reason behind that? And so this, we believe, is the main contribution of the literature. And in addition to that, it's also contributing to, as I will come to it later, the literature that uses survey data. In our case, in our region, which we found that for Rwanda specifically was not extensive. So the paper also contributes in this way by using the recent FinScope 2024 data, which is a consumer survey that is broad and comprehensive, and that will also briefly explain later. So what do we do basically to achieve our objective? So the first part is a descriptive analysis part, which is basically looking at secondary data. We use two types of data. We use secondary data from payment statistics here at BNR. So at the National Bank of Rwanda, we receive data from all these operators, be it the banks that operate or that provide that provide digital payment platforms, but also microfinance institutions and others. And we receive this data, and I would say it's data that is on the supply side. transaction data, how much are they actually using. And we contrast that with microdata, which we believe is sort of the demand side, because now the microdata will be showing us what they want, or what they sort of perceive is important to them, or which digital payment channel they perceive is important to them. And we're able to contrast this supply and demand perspective in our paper. So the descriptive analysis part is basically establish stylized facts. And later we have an empirical analysis part that actually uses a model, a regression model that now tries to quantitatively or use a more sophisticated way to establish the stylized facts that we see in the model, see if they're also replicated through the lens of a more sophisticated regression model. So just a few things on the FinScope data that we use for both on the descriptive side and the empirical side is that the FinScope data is widespread. It has about a sample of 13,000 individuals across, I would say, the rural and urban regions of the country. And it accounts for demographics like other survey data, the age, the education, and marital status. These are all things that were captured into the data. And we use heads of households. We capture the responses of heads of households, as we believe they are fairly well enough represent the perceptions of other households, and they're actually most important in terms of allocating budgets and which ways in which they allocate the budgets, or the channels through which they allocate their budget. So this is basically what we use in terms of the microdata. So on the descriptive findings, first from the payment statistics, we see this sort of tremendous increase in the number of internet banking subscribers in Rwanda since 2012. And this is also matched with the value of these transactions, which shows that these are active subscribers that are contributing to increasing the value of these transactions. And this is a number that we've seen increasing tremendously from 0.7 billion Rwandan francs in 2011 to about 17,300 billion Rwandan francs as of last year. And this is the same in mobile banking, not just internet banking. We see a tremendous increase in transactions, so the value of these transactions that has increased rapidly. And we also notice the same when we look at mobile payment subscribers. So mobile payment subscribers have increased tremendously in the past decade, I would say. And this is actually supported by availability of these mobile payment agents, because one of the findings that I will talk about later is that the ability for individuals to have agents supporting their activities on a daily basis pushes them to subscribe. So we think it matches these findings of the story from the individual's perceptions is what we see from the supply side data, where the number of agents increasing is matched with the number of subscribers over time. And this is reflected again in the value of these transactions that has picked up tremendously. So when we look at the demand side now, the survey data, the micro data from FinScope, the different questions that we try to, that were asked to the participants in the surveys, but we try to bring some of them to bear. The first being, how do you mostly send money? And this is a question that was asked, and you could see on the chart here that mobile money when they're transacting. And this is something that they do, either sending it inside or outside. And you can see that it is at a rate of upwards of 90%, which shows how mobile money has taken an important part of our societies today. And this is the same for how they receive money. So they actually receive money mostly through mobile money. So the Momo, which is an example from MTN that I referred to earlier, but also Airtel mobile money are examples of channels that enable individuals to conduct these transactions. But also when you look at after sort of receiving and sending money, the other thing that is important is, okay, do they borrow? And what we see is that they also borrow in using digital payments, and Again, on the chart on the left, we can see that MTN and Airtel Rwanda actually have an important share of these microcredit that they've been providing, and they're now second to microfinance institutions. Microfinance institutions that traditionally have ballooned in sub-Saharan Africa, the literature has pointed to, are now followed in our specific case by microcredit offered by Airtel Rwanda, 26.7%, which is far higher than the frequency, for instance, of people that borrow from banks such as the Bank of Kigali, which is a leading bank at 13.7%. And so this is actually something that is also important: the borrowing patterns, but also the saving patterns. So once you borrow, where do you save your money? It is again through these mobile payment channels like MTN, which has a share of 52.7%, based on the FinScope survey. This again is perceptions of people where they perceive how they do. It's not the actual transactions, but data on, that they report on how much they transact and where did they save the most and where did they borrow from the most. So this is what we find in this data. And the particular reasons they highlight for choosing a specific saving channel, and this is the first contribution in terms of trying to determine the intensity of adoption, is that they highlight that one of the important things they look at is the convenience of transacting, which is the color. I don't know if I have a pointer here. Yes. So the dark blue color, which is the convenience or the proximity of this specific access point, we see that this convenience is available in different across different channels. So when, let's say, a branch of a specific bank is near you, you're more likely to save there for that particular reason. And this is something that they report. But also we have a trust or the security that they feel is associated to this particular outlet. And we also have another important contributor here, which is the ease of use. So you could see the orange color being replicated somewhat across most of these graphs, which is the ease or the ability of the people to use it efficiently. And this is an example of the sort of a first finding on the intensity of adoption, or the drivers of intensity of adoption. And later we'll try to see if we could obtain the same results using a more sophisticated approach. And spending patterns, I will not dwell on this much. We have spending patterns that I believe replicate what we see elsewhere in sub-Saharan Africa, where most of the expenditure at the household level is it goes to food, which is something that we also wanted to highlight here. And the most preferred payment mean today remains cash, which is and something that we actually find is more prevalent in rural areas of the country. And this is because despite the fact that the examples that we've seen from talking to different individuals, but also some of what the people conducted the survey report, is that although individuals receive money and send it through mobile money, because of this lack of penetration of infrastructure in some rural areas, they prefer to withdraw the money and convert it into cash that they will readily use on a daily basis to transact, to buy food and other things. So this is why we see this most preferred payment mean at the country level, sort of the majority of survey respondents still being cash. And this is because cash is convenient to them for this specific purpose, for this specific reason. And this is also something that shows now why did you choose a specific payment over another payment channel? All kinds of payments, be it digital payments or cash. And the first thing that they report is convenience, which is about 22% of the respondents say that it was convenience, and followed by the effectiveness of the costs or the transaction costs. And then we also have the ease of use as a significant share, 36%, followed by convenience, and then followed by the transaction costs. So these are the three main reasons that they've uncovered, that they've reported through the survey. So We also look at another
Tassi?
concern that they look
Tassi?
at when choosing. Yes.
We are kindly out of time, and
Okay. Sorry.
please kindly sum up in a minute, please.
Yes, yes. So basically, to sum up, I'll jump to the results of the empirical analysis and show you how they replicate the descriptive findings. Is that what we tried to do after using these, or after taking stock of these perceptions, we quantified them into an index, and this index of electronic payments here that we're seeing here being the intensity index captured by how well they use the electronic payments over the total payments. So all the other payments that they reported. So there are different payments, about 15 payment channels: cash, digital payments such as mobile money, credit cards, and everything. And so we report the total sum of these payments, and we take the share of the electronic payments, and this creates this fraction that can range from 0 to 1, which is why we use a fractional and logit and probit model, because of the nature of this dependent variable in our case. And when we take it to the model, what we see, I will just skip through to the results. What we see is that the same findings that we've seen through their perceptions descriptively is what they actually report. So here we highlight significant results on convenience, cost, but also security. So here, the convenience variable is taken to represent a low level of convenience, and we square it to find the high level of convenience. So what we see is that the low level of convenience here reduces the likelihood of adopting the electronic payment channel, which is the dependent variable, and a high level increases this likelihood. And this is the same for cost and security, which are the three main variables that we reported through descriptively, that they reported through their perceptions. And this is something that
Thank
we
you
see
very much, Tassi. We'll
showing these differences, and maybe get to conclude later.
Unfortunately, in the interest of time, we have
Yes.
to leave it at that. We appreciate, and kindly keep online, because we are going into a question and answer session. Colleagues, the floor is open, and questions are welcome across the three presenters. Yes, ma'am. Kindly introduce yourself, and then you share the question. Try to be as precise as possible, and try to target the question to the person of interest. Thank you.
Comment is to the first presenter on digital financial tax. Two comments. The first being that I am speaking from the perspective of a taxpayer and not an economist. I'm an engineer. So I wanted to say that I think as a taxpayer, there's a distinction that needs to be made between the digital service tax and the digital payments tax. Or more broadly, as understood by the market, the digital services tax was more of an over-the-top tax, social media tax, and the protest, whose picture you shared, actually related to that particular tax. That one was completely repealed. And the comment I wanted to make there was that amongst the reasons for objecting to this tax, it was not just emotional on the part of us taxpayers. The point I want to make there is that there was a real imperative to oppose this tax. I was in telecoms then, and I defied this tax for the simple reason that I felt it was a regressive and ill-conceived tax. We are trying to promote digital services, and so taxing it at an early stage of adoption in this market, I felt was regressive, and I was happy when that was completely repealed. So coming to the digital payments tax specifically, or more or less the mobile money tax, yes, there was a fight against it, but I also wanted to add that they are now, once again, from a technical perspective, the initial law targeted a technology, specifically telecoms, but there have been further developments since then. Today, mobile money is not just issued by telecom companies. There are other ways of transmitting mobile money, specifically by fintechs, which are not telecoms. And so the tax was limited in view because it targeted a technology as opposed to a way of transmitting money. And I will also add that come 2024, there was an amendment to that mobile money tax, and it has been expanded to all digital payments by the inclusion of fintechs as well. So those are the two comments I'd like to make. Thank you.
Thank you very much. Yes, Professor Bale.
Thank you very much. My name is Edward Bale. I have one question for the first two presentations. Now, one concerning the mobile money taxation, we note the several strengths of doing so on part of government. For example, revenue mobilization, the formalization of the informal sector and others. But also there are others like the regressive nature of this type of taxation, double taxation risks and others. But my question is whether the paper explored to suggest the most viable and the equitable policy alternative. For example, like taxing the profits of the telecom operators rather than taxing the transactions themselves to avoid the risks that I've mentioned above. And then for the second paper, we note the complementarity between mobile money and the banks. But one of the conclusions made here is that mobile money tends to crowd out banks. Maybe I missed it a little, but I have a question. Could you clarify whether this effect is uniform across all banking services, or it is concentrated on specific functions like savings or transactions? And also, how does this one vary across income groups or locations, say rural and urban? And the reason of my question is mobile money tends to mobilize the underserved or the unbanked, segment of society. And the banks have tried to actually build a partnership with the mobile money. And we have witnessed a flow of transactions from mobile money to the bank. So how would you defend the crowding out effect? Thank you.
Thank you. Yes, sir. Yes, please.
Hi, it's open here. Andrea Presbiter, IMF. Also, I have a question for the first two speakers. I think in both of them speak about the regressivity of the tax, which I take. I wonder if you can say a little bit more about something in the data. For instance, I guess both papers have like relatively rich data. Can you say something about, or can you show something about like the reduction in, or the reduction in the use of the transaction depending on sort of individual income or anything like that? Because I guess you show something relatively aggregate, and that's sort of to be the average reaction, but one would expect reaction to differ across type of individuals. And on the second paper especially, all this effect is driven by high ATM versus low ATM geographies, if I understand correctly. And one question could be, could that proxy for something else? Meaning one potential alternative story could be that when you have a lot of ITMs, it's sort of richer regions, and that could be a lot of high financially sophisticated individuals or more financially sophisticated individuals vis-a-vis other regions. And so those people can be more inclined to switch vis-a-vis if you have less sophisticated individual. So I wonder if there could be another story. And finally, the results on the bank are somehow big, at least the way I understood, like the banking agent. And they wonder, like, I understand the mechanism and I find it credible, but I wonder if, is it the case that maybe bank has a strategy even before that, and sort of you're confounding two different things. One is the shock coming from the tax, and something is a more general strategy for the bank to tap into this potential source of deposits.
Thank you.
Thank you very much. Shamira Chimbogwe, proprietor Pivot Payments. My question goes to the first presenter, specifically on the mobile money tax. So recently the report on the industry statistics came out, and there was a significant drop in withdrawals at agent points. Now, speaking as a practitioner, this affects the point at which money gets into the system adversely, because if I put money in the system, I'm trusting that at the withdrawal point is when I'll earn more as an agent. Now, because there's the 0.5%, people are actually withdrawing less, which means there's a bigger churn for mobile money agents. So my question, therefore, is, isn't this defeating the purpose of financial inclusion, specifically at ground level? And two, if you tax me when I am withdrawing money, and also the company that is providing the service is taxed on the same transaction, and then the agent is also required to pay tax on the same transaction, probably end month, isn't that over-taxation of a single transaction? Thanks very much.
Can we take, then our presenters can respond.
My name is from Monafric. I have one question. Did the study look at the impact of the mobile money tax on cross-border transactions, especially, so did it follow the same trend like the second paper where there are more bank deposits when the tax was introduced on mobile money?
Okay, thank you very much for the questions and the comments. I'll do it sort of in the order. So to the first comments, thank you for your remarks on the social media tax. Our paper didn't look at social media tax, although they were introduced at the same time. And then I don't have any particular opinions on the 2024 amendments. This is news to me, but it's interesting to hear from what you said, and you'll correct me if I'm wrong, that there's still a different tax treatment between fintechs, now broadly conceived, including the telecoms and people like Wave, and how similar transactions in the traditional banking sector are treated. So if you're still not equivalent across the financial sector, it sounds like, which was one of the calls from the financial sector in terms of possibilities to reform the tax system to make that playing field level, and it doesn't sound like that's the intention of those amendments. On the whether there's policy alternatives, in our paper we didn't look at different policy alternatives, but I'll point you to the work of my colleagues at the ICTD, where they do look at, in contrast to transaction taxes, there's other countries have experimented with taxes on the fees, with taxes on turnover, specific sector taxes on turnover, and there's costs and benefits of all types. So there's always going to be a trade-off in the type of policy, the option that you choose. But some of my colleagues have looked at different models of doing this, and I'd point you to them. On your comment, Andrea, we didn't, for the paper that I did with Doris, we didn't have access to the transaction level data at that stage. But in work that I'm now working on with colleagues from the bank, we're trying to dig out exactly what you're saying, differences across types of users, types of transactions, and looking at those elasticities in response to not just the tax introduction, but also the reduction in November, so whether those elasticities change, whether taxes are increased or decreased. And finally, on the industry statistics showing a reduction in withdrawals and the impacts that this might be having on the profitability of agents, I think your point is very well taken. In our study with Doris, we weren't really looking at the effects on agents and that side of the market, but it's really under-analyzed and a part of this sector that I think deserves more research attention.
Thank you very much. Please.
Thanks for your questions, all. So to answer yours about heterogeneity, geographical level, financial inclusion, and how behaviors in terms of changes in banks' usage are affected. So indeed, the paper tries to study heterogeneity at geographical level. So how the mobile money tax affects people in different places. In terms of a behavior at the bank level, so you were talking about savings. We had a slide showing what are the kind of deposits that are changing. So what we show actually is that long-term deposits and savings especially register no effect from the tax. What is registering an effect are short-term deposits, so demand deposits and cash deposits in the bank. So this for us was like a validation of the fact that people are using banks just for very short-term deposit, just for putting money which can be withdrawn very easily to make payments, and not for other purposes like savings, on which we see no significant effect. And Andrea, for answer your questions about ATM's density being a proxy. Sorry, I get it, but there was something that we thought about. The only test we did was to introduce. For a robustness check, we did was to introduce the interaction of a post-dummy tax with a proxy of richness at individual level by using the average amount in the mobile money balance before the tax. Results were not changing, but I understand this. I mean, I didn't show this, and this is not enough for sure to answer your questions. And I fully didn't hear your question about the banks. Can you please repeat it? Yeah, so this is the thing about banking agents. This is a service which is not directly provided by the bank, but these are people who apply for becoming a banking agent. So these are not direct employees of the banks. It's just like mobile money agents. These are people who decide to provide this kind of service, and they can decide for which bank to provide this service. So again, what we saw is that banks with the highest ATM density are the ones registering the highest increase in the number of banking agents. So like banking agents wants to be with a bank with the biggest network of ATMs. And on the other, yes, we see that there is an increase of banking agents right in the place where there is a high ATM density. Just like banking agents want to be in a place where there is easy usage of cash, so where people can easily withdraw the cash which is deposited at banking agents. So ideally, we don't know of any incentive that banks gave to the development of banking agents after the tax. Actually, as far as we know, nothing changed in how banks tried to incentivize the people applying for being a banking agent. This was a service which was already there since 2017, and up to the tax, the number of banking agents was almost zero, and we just see an increase like in the month after the introduction of the tax.
Thank you very much, Lorenzo and Adrian, and our audience. Once again, thank you for the questions. Unfortunately, we are running out of time, and I'm aware that we've kept you for long without any bite. So kindly allow me invite you for a cup of tea that should take about 10 minutes, and then we shall reconvene. The tea is, we exit, and then we take our immediate right to the senior common room. Thank you. The MC, please.
Okay, thank you very much, our moderator and our speakers. Can we please give them a round of applause? Now, as Professor Okumu said, most of the questions, we ran a bit out of time, but this is what I believe the tea is for. You'll have a bit of networking, and you're able to ask your questions directly to the presenters. Thank you very much, Adrian. Thank you very much, Lorenzo. And from Kigali, thank you very much, Tersi, for joining us. So, ladies and gentlemen, it is my hope that we shall be back here in 10 minutes to begin session 2 of our conference and our lectures. Thank you all very much. I will be seeing you here at 20 minutes to midday. Sorry, ladies and gentlemen, Professor Okumu, Professor Bale, as well as our presenters, please remain for just a photo of your session, and then we shall let you go. Sam and other members from Bank of Uganda Research Department, please feel free to join me up here. So Adrian, Lorenzo, Professors Okumu, Bale, please join us for a group photo here for your session. Sam, please help me get Adrian. Once again, you're all very welcome to this conference and a lecture on the macroeconomics of digital payment systems. It is held in collaboration with Macquarie University, IGC, the International Growth Center, and Bank of Uganda. So our previous session, held earlier on, was focusing on digital finance, taxation, and the future of money. We're looking at policy lessons from East Africa. That session was ably moderated by Professor Kumi Ibrahim from the School of Economics. This session is going to be themed Unlocking Financial Inclusion through Mobile Money Costs and Policy Trade-offs. This will be our session 2. Again, it's called Unlocking Financial Inclusion through mobile money costs and policy trade-offs. It's very good that we have some of the big players in the telecom and mobile money sector with us here today. I saw some gentlemen from MTN. I've seen some people from Wave. You're very welcome. Thank you for joining us. Once again, my name is Ralph Akorabirungi from the Bank of Uganda, and I will be your MC. Let me ask our session chair, Dr. Anthea Paello, to please come up and take her seat so that we can begin. Dr. Anthea, please, can you please give her a round of applause as she comes up? Dr. Anthea Paello is a competition and digital financial services expert, currently working for AFI, the Alliance for Financial Inclusion. Our presenters are going to be Nicola Limodio from Bocconi University. Please join us. Thank you very much. Welcome, Nicola. He will be presenting a paper titled Mobile Money Interoperability. I hope I got that one right. And Financial Inclusion. Mobile money, interoperability, and financial inclusion. Our next presenter is Anthony Kamwesije and Lina. Please join us. Anthony and Lina will be presenting Transaction Cost Index, measuring the true cost of digital financial services. Lina and Anthony, very welcome. Take seats. These will be our presenters and speakers for session 2. After this, we shall as well go into a Q&A that will be moderated by the session chair. So, session chair, over to you. Thank you very much.
Hello. Okay, thank you. Yeah, great. Good afternoon, everyone. You're very welcome to this session. I'm personally very excited to be listening to these papers. And I'll just take the time to introduce the panel. First, we have Nicola Limodio. He's an assistant professor of finance at Bocconi University. Nicola's research focuses on banking, corporate finance, and development economics. He's particularly interested in researching the role of banks in emerging markets, which are the most relevant constraints they face, and what is the optimal design of local financial institutions. He has consulted for EBRD and World Bank, and his research focuses on the role of banks in emerging markets, the identification of their constraints, and the optimal design of local financial institutions. He has a PhD from LSE and an MSc in economics from the University of Pisa. I'd just like to invite him to go to the panel as I just briefly and quickly read his abstract. His paper investigates the trade-off between competition and financial inclusion resulting from vertical integration between mobile network operators and mobile money operators, joining newly assembled data on mobile money fees through the Wayback Machine with sources on network coverage and financials. It examines the staggering across African operators and countries of platform interoperability, a policy that promotes transactions and competition across mobile money operators. The results show that interoperability benefits users by lowering mobile money fees and their dispersion across operators. However, These positive effects are offset by a decrease in mobile money towers, mobile towers and network coverage. I would ask you to please give Nicola a hand as he starts his presentation. You have 20 minutes.
So thank you all for being here and having us here. This is a great conference, and I really look forward to presenting the paper as soon as the slides come up. So there is some technical difficulties in progress, but let me just start to give a bit of an introduction. First on this topic, and to give a very big picture. It's been very difficult to study these issues of finance, digital finance and macro in low and middle income countries. There has been a focus, a very strong focus on very micro applications and randomized controlled trials. Luckily, what we are trying, many of the presenters in this room, to really push the frontier to study more digital finance, the regulation of these services, and generally policies of macro and finance in emerging markets. The big issue that I think, people like Andrea and I have been working on is that the policies applied in emerging markets are often a copy-paste of those in high-income countries. But as you know better than I do, there is a big difference in the underlying fundamentals. So, yeah, that's basically what we are trying to look. And that's as much as I can introduce. Almost there? Good. Oh, fantastic. So let me go directly into the paper so we don't. Yeah, let me just skip all the way to. Okay, so the rise of mobile money. I don't need to tell you that this is one of the widest digital payment systems. And as also Lorenzo pointed out, it has effects on many variables in this economy. Now, we know a lot about the effects of mobile money. We know a bit less about the financial institution behind mobile money, which is the mobile money company. So that's really what this paper is about. And this is going to be in the context of interoperability, where interoperability is a policy that promotes competition by facilitating payments across different platforms. So let me give you, yeah, that's basically it. Let me try to give you an example. Basically, there is the mobile money company, MTN, and many others. On top of the mobile money company sits the mobile network companies. These are vertically integrated, which means that they are owned by the same company. And in many cases, you can only use on MTN network, MTN money. Now, there is a trade-off here that this paper analyzes. The vertical integration creates high fees, gives the opportunity to the mobile network company and the mobile money company to charge high fees on payments. However, this gives incentives to the mobile network company to expand. They have a wide network of towers and service. Now, interoperability will be the ability to use, you have MTN network and have multiple mobile money services down the road. There is more competition. The mobile money platforms will have to compete to get your money, and this will lead to lower fees. We find that fees decline substantially on mobile money payments. However, there is no free lunch. The decline in fees leads to a decline in mobile towers. Often rural areas where towers are most expensive to run because they run on diesel, typically, they will be cut or the frequency of their service will be reduced. Therefore, what I try to give you in this picture, and I will give you more, is basically that there is a trade-off between competition, fees, and financial inclusion, service. So let me give you the paper in two pictures. This is a paper across Africa. We have data on coverage of all African countries, data on fees of all African countries, and we know in which year each country adopted mobile money interoperability, generally through a national switch. Now, this is the average fee in Africa over time. You can see that this is around 4%. If you divide this fee between companies that become interoperable and companies that are not interoperable, you see that non-interoperable companies, they were charging 4%, and they keep charging 4% on average. Those that become interoperable really compete on fees, and fees go from 4 down to 2%. This is good. Consumers are happy. But if we look at coverage, this is the average coverage in a district over time. What percentage of a district has 2G coverage? Overall, we see that this is around 90%, but there is a lot of heterogeneity behind. Companies that are not interoperable, so those charging the high fees, almost get, by the end of 2021, to 100%. They have incentives to keep investing in towers. Companies that become interoperable, we see that coverage drops from an average of 90% down to an average of 80%. And rural areas, poorer areas, are those that see the largest drops in coverage. So that's really the paper to deliver you. I could stop here, but let me give you some details to get this going. Okay, telling you a little bit what we do. First, we see that mobile money fees are relatively high as a percentage of payment on network to transfer from one company, the same company, it's gonna be 4%. And for low value payments, for small payments, these fees can get as high as 30%. Now, then we study what happens when interoperability arrives. Here we get more sophisticated. We use regression analysis and all the latest techniques in econometrics. And we see that fees drop, the median fee goes down by 0.2%, which is 20% of the relative. And low value payments, small payments, the one that had the highest fee, see the largest drop, basically. Networks become weaker. Over average coverage drops by 5%. There is a 3.4% higher probability that an entire district will have no coverage at all. And we see that the number of operators that are competing in a district drops by 18%. So interoperability delivers good news, lower fees, but also bad news, less coverage. And we see that this decline in coverage is accompanied by a decline in financial inclusion. People lose their mobile tower, they lose their network services, they lose a lot more than just mobile money. Now, why do signal and towers go down? This is the question that an economist, as an academic, I am particularly interested in. Because if you think that towers are a variable cost or a sunk cost, depends. So towers in high-income countries like Italy are a sunk cost. They have been installed many years ago. They are electrically powered. The operating cost of towers is very low. So if you have a negative cost to your marginal revenue, this will not lead to a decline in something it's already been paid off. But in many low and middle income countries, as many of you may know, towers are off the grid. They are not connected to electricity or are in areas with very unreliable power. So what do mobile network companies do? Well, they power it with diesel. This is expensive. On top of that, there is security, maintenance. This is a big chunk. If you look at the average cost of a tower in Africa, more than 60% it's OPEX, it's operating expenditure. So if you are making less money from mobile money, if fees go down, you're gonna cut some towers. So this is a key difference between low-income countries and high-income countries relative to telecommunications. Okay, let me skip the literature. I'm happy to chat more, time is tight. Let me tell you a little bit what we do with data, how we identify, and the main results. Then there is a paper you can find it on my website, and we can interact more. Now, what we built was mobile money fees for 129 companies over 42 countries. I'll tell you later how we do it. Let me tell you that, this is the part of the paper where we got creative. Many people at famous, labs were like, oh, it's impossible to build data on mobile money fees. It's very difficult. We have to do surveys. They are expensive. But actually, we got creative, and that's the key creative part of the paper. We have data on network coverage by GSMA. We have data on financials of companies from Orbis. We have data on interoperability. We went on central bank websites. Typically, interoperability is related to national switches being introduced. And then data on financial inclusion from the World Bank, IMF, and DHS. Okay, so this is the example I always have. So it's not because I want to talk about MTN Uganda, but in March 2023, you can just go on the website of MTN by clicking on this link, and you will see that between 500 and 2,500 shillings, if you send to MTN, you pay 100, to other users 100, and so on. You see that that's how the payment structure looks like. Now, there is a website called Wayback Machine that's the memory of internet, in a sense. You will type in this link, and you can basically see the history of this website over time. So just to give you a sense, this is on the left, it's MTN in 2023. On the right is MTN in 2020. And you can see that sending money to MTN was actually cheaper, at least for the low amounts, but was much more expensive for cross. So we build all this data together for many countries, for many companies over time. And we start looking at simple summary statistics. So I gave you the mean. Let me show you something more interesting here. This is the average fee by transaction bracket. One will be the smallest amount that you are sending, something like 500 to 2,500 shillings. The average fee is more than 30% in Africa. Then second bracket is more than 10%, third bracket about 5%, and so on and so forth. Larger payments on average are cheaper with respect to fees. And you will see that mobile money, I'll show you that mobile money kills this. The fees will basically become equalized across different brackets. Sending a small payment or a large payment became almost equally costly as a percentage of payment. Just to show you the data we have, this is a country, you may know or may not know. We can see from GSMA where is the coverage of a company, of operator 1, where is the coverage of operator 2, and where this coverage is overlapping. And so we are using this data on coverage. We divide this map in districts, and we just count what fraction of the district is covered in signal. So we can measure operator level interoperability and country level interoperability. Let me just skip and to show you where and when interoperability was introduced. That's 2015, 2017, 2019, and that's basically what we, in 2021, that's what we get to study in our paper. Comparing countries that had interoperability and companies in countries that had interoperability with those that did not. And then we can also see at operator level which have interoperability and which do not. So this is a picture of fees. This is the median fee from a mobile money company. What do we see? Basically, before interoperability, fees in countries that had interoperability and did not looked approximately the same, but interoperability leads to a major decline in fees by 20% on average. If you split these fees by the bracket, small brackets, medium brackets, and so on, you see that all the decline is due to the lowest value payments. So that's where companies cut the most, because honestly, that's where the fees were the highest. And this is the picture I showed you before. Here, each dot is a company in a bracket. You can see that before interoperability, again, as we already said, small brackets have higher fees on average and also more dispersion. After interoperability, that's what fees look. So there is not only a big decline in fees across the board, but you see that dispersion going down. For the economists in the room, this is called the law of one price. What is the marginal cost of sending a small payment or a large payment? It's the same. What's the cost of sending a short message with 1 character or with 10 characters? It's the same. So with more competition, Companies bid for the marginal cost, and the marginal cost is basically the same. But it would be a mistake to think that lower fees are necessarily good for customers. We are economists. We think about what is the trade-off behind this. So we look at operators. So basically it will be, I don't know, AfriOcel in a certain district, MTN in another district, and we see what happens to their coverage over time. We see that coverage drops, and drops quite dramatically. Okay, before interoperability, companies were approximately all the same, but afterwards, interoperability really leads to a decline in coverage. This is the percentage of a district. And, again, this table shows you. This is an operator in a district. You may be wondering, well, it doesn't matter if MTN leaves, I still have AfriCell in the district. So we aggregate at the district level. We put everything together, and we see what's the overall coverage. And we see a very similar picture, okay? Overall coverage is declining as interoperability kicks in, and the numbers are very similar. So lower coverage, lower probability of having any signal, and fewer companies operating there. Are operators happy of interoperability? Not really. So on average, we see that interoperability hit. I am done. Okay, I still have 16 minutes here. So I'm measuring. For 2 minutes? Perfect, I'll finish. I'm very close to the end. So we see that interoperability led to a decline in cash flows, in assets, in profit margins, in return on equity. So companies are hit negatively by interoperability. And the last part is on financial inclusion. We can measure two variables from the DHS, the number of mobile transactions and the frequency of internet usage. We see that interoperability seems to have a negative effect on mobile transactions, but once you split between rural districts and urban districts, it's completely different. If you're in an urban area like Kampala, fees go down, it's good for you. Towers are not going to be cut. This is an area where companies are present. The problem are going to be rural districts, where running a tower is very expensive. And there you see that basically interoperability has a positive effect on transactions, column 2, in urban areas, and a negative effect in rural areas. Same thing on internet. Internet, which is another measure of whether a tower is active, basically increases in urban areas and declines in rural areas. So the last thing that we propose, and then I will end, is basically thinking about what policy proposals to bring on the table. What should regulators do in our view? Well, let me give you an analogy with supermarkets. There is a lot of work showing that supermarkets charge the same price across areas with very fancy supermarkets and cheaper supermarkets. Mobile companies charge the same fees in urban areas and rural areas. But as many can tell you, the marginal cost is very different because the marginal cost is low in urban areas and much higher in rural areas. So in theory, if mobile operators could charge heterogeneous fees, lower fees in urban areas and higher fees in rural areas, they would not kill towers there. So one thing that can work this way are subsidies for rural telecommunications. Why? Because basically subsidies for rural telecommunications create fee heterogeneity. If a company is given a subsidy to keep a tower, it's as if that fees from those towers actually are higher. And so we see in the paper that the introduction of rural telecommunication subsidies counters this negative effect of interoperability on towers, but it also has a negative effect on urban towers. So companies reallocate towers between urban and rural. Okay, so now I will finish. There is a lot more in the paper, and but basically what do we see? We see that interoperability, we study on mobile money industry, there is a trade-off between competition and inclusion. We learned that financial inclusion comes at a monopoly cost in this setting. People are included, but companies, if they don't have competition, they basically extract all that they can extract. And there is a link between digital platforms and infrastructure, as it was pointed out earlier. So the idea is to keep studying the role of financial institutions, and mobile money companies are financial institutions in these countries. And that's basically my agenda on finance and development. So thank you. And I'm almost on time. Thank you.
Thank you so much. That was very interesting. I'm sure it's going to raise a lot of good questions. I'll introduce the next speakers. We have Anthony Kamwesije, who is an experienced researcher, project manager, and survey CTO programmer, who has been in the research field since 2009. He's very interested in transforming research into policy through advancing high-quality results. He has worked on several projects at IPA, including framing cash grants, e-warehousing, social norms, and teacher transfers. He has held roles as a field officer, anthro-enumerator, field manager, and has worked at Baylor, Uganda. Welcome, Anthony. And then I'll introduce Lina Postata. Lina is a senior research associate at IPA Uganda. She has worked on different projects under IPA's Consumer Protection Research Initiative, including research on the cost of mobile money transactions, usage of digital financial services in Nigeria, and a cooperation with Bank of Uganda. Before IPA, she worked as a research assistant at the University of EAFIT in Medellin, Colombia. She was previously a trainee at the European Parliament within the macroeconomic policy. She holds a master's degree in development economics. Please welcome them as we put up the slides. Their paper is on the true costs associated with digital financial services in Uganda, emphasizing price transparency, monetary expenses, and reliability.
Good afternoon, everyone. I'm pleased to be here and to share with you our experience regarding measuring the true cost of digital financial services at IPA, and specifically looking at mobile money payments or mobile money transactions. Yeah, it's going to be a quick outline. We want to take not a lot of time. Should look at the motivation behind this, methodology, and my colleague Lina will come and talk to us about the results. Yeah, so we all know that the uptake of digital financial services like mobile money has very positive results. For example, reduction in poverty levels, improvement in welfare, which could be attributed to consumption smoothing by sharing over larger social network risk over larger social networks. We look at consumers can shift to higher productivity employments if they are well included into the financial system or ecosystem. Then we also see that migration can also produce lead to productive urban centers while remitting finances or monies back home. And all this can be achieved when financial inclusion, the ecosystem for financial inclusion is very smooth. But what still has many questions to answer is what pulls people, what pulls customers to take up these digital financial systems. And these can be looked at in different ways. We could group them and say, okay, the knowledge levels and the perception of the customers about the digital financial systems, the trust of the customers in these digital financial systems. We could also look at the product features. What are these financial service providers providing to the people? Talk about linkages to other products. When the customer is in one, interacting with one system, are they able to move to the next product? Interoperability. Now, as like I said just a short while ago, when we talk about mobile money transactions, we are looking at both monetary costs, and by monetary costs, we are looking at formal fees. We have been hearing about, how much is being charged. The different MNOs have their rates per transaction amount. So we look at that. What are they charging across networks? Other informal fees, what are they? we have, we have situations, I think most of us know situations whereby you go to an agent and then they charge you an extra 1,000 shilling. And our thought, the line of thought around this is that should these formal fees or informal fees be very high, then you would find that they deter customers from using these financial services. Now, looking at the other way of looking at costs, we have non-monetary costs. Now, with non-monetary costs, we are looking at, price transparency. We are looking at failure rates. Most times, you walk to the agent, and then maybe the agent doesn't have float. You walk to the agent, and then the agent is not available. There's that time component. There's that time that you're losing when you're going to make a transaction. Or sometimes the agent says, no, I don't want to do that, depending on what reasons they have. All that is a cost to you because time is money, So with this, we are looking at that, and it has a component on how much of the digital financial systems the consumers are going to use. And all that put together, if all these come into play, then we have a situation whereby there is reduction in the usage of the digital financial systems, which in the end affects, the whole goal and component of financial inclusion. Speaking about the methodology, what did we go through to come up with this? We do have activities to do with price scraping. We do have official price lists that, you go to the websites and all that and get out all those prices related to that. Then there are policy reviews that we conducted across the different countries to see, what the policies regarding digital financial payments. Then we had fieldwork, like I said, in Uganda, Tanzania, and Bangladesh, where we did, local mystery shopping. We had mystery shopping done by professionals, trained in IPA enumerators, done by customers whom we intercepted at different mobile money payment systems. We then had recruitment of participants at household level, to try and, have a better way of, look for a better way of measuring these costs. And this, we would want, when Lina starts talking about the results, think about this in a way of urban setting and rural setting, because this was done both in urban and in rural. And we had over plus 1,500 transactions and with over 400 agents. And the transaction types that we shall be looking at, and I know Linda is going to talk about this in the next session of the results, the things, the cash-ins, cash out, off network, account to account, all these types of transactions were considered during the course of the study. At this point, I'm going to give it to Lina to take us through the results based on this methodology and the idea behind the design of this study. Thank you.
Okay, so like Anthony said, we did mystery shopping. If you know what that is, we asked consumers which were local to the area to go and do transaction with an agent. And then afterwards, we asked them to fill out a survey about their experience. Let me see. Oh, okay, got it. Yeah, so let's move to the results. We have results regarding to pricing transparency. I'm not very good at this. Okay, there we go. Okay, got it. So if we start with price transparency. So we did this in 3 countries. And when we visited agents, or shoppers did, 64% of agents were present when we attempted to visit. And this means that in these other cases, the customers tried to visit the agent and they did not find the agent there. Then verbal disclosure, meaning that the agent told the customer the price, and this is very low. Uganda still had the highest rate, but generally agents do not disclose prices to customers. Breaking this down by geography, so urban agents had a higher prevalence of price lists, but they were less likely to disclose the transaction fee. Also looking at, we did 2 rounds of agent censuses, and in the second year we found that agents that were new in the market had higher prevalence of price lists and also were more likely to disclose the fee to the customer. So then remember we had a desk review part where we scraped price lists of website, and we did this in an automated way. And we also did some customer care inquiries to try to measure what is the customer service on the behalf of Airtel and MPM, which are the biggest providers in Uganda. So most providers had price lists on their websites, and they were relatively quick to find, but not everyone broke this down into taxes, meaning that information on the provider fee itself is limited. And also customer care was not very straightforward, meaning that redress and complaints are hindered by the availability of customer care service. So these are results from 16 countries taken together. In Uganda, we received a reply for a customer care inquiry after 1 day. So then overcharging. So now we're moving on to the monetary costs. Overcharging is not very common, but it is in Uganda. So 1 in 10 transaction was subject to an informal fee. And this is the kind of fee that the agent charges above the provider fee. This is of course prohibited. The Bank of Uganda also has clear statement that this is not allowed, but nonetheless, agent charge the customer additional fees. We did not find any gender differences, neither on behalf of the customer or the agent themselves. But we did find that agents that were newer and that were rural were more likely to charge an extra fee. Also that lower educated consumers are more likely to be overcharged. So cash in transaction and OTC transactions were more likely to be overcharged. So OTC is, should be free because all it involves is an agent depositing money. But this is one of the most common transactions that is overcharged. Desk work, we have heard a lot about this today, but this table shows transaction provider fee. So this is the fee taking together tax, provider fee, and as a percentage of a median transaction amount. And Uganda has one of the highest, especially cash out charges, although Tanzania is almost double that and is definitely topping the list. Uganda also has relatively high off and on network charges, so these are the official fees. Now, these graphs are showing a relationship. So we're finding a bit, as economists, we would expect economies of scale, meaning that higher mobile money account ownership would mean that we have lower prices. This is not the case, so we're seeing the opposite. The same that higher market concentration is actually also associated with higher aggregate costs. So moving on to the reliability. So we had in 24% of cases approximately, the agent was not present, and the success rate was at 77% in Uganda, meaning success, agent has no float, or the network was down, and all of these add up to one of our non-monetary costs. Urban areas have higher agent presence rate and also higher success rate. Also that agents that are mobile, these are the agents that operate from mobile structures such as umbrellas, or also have higher success rates. So This also means they have more availability to asking each other for float, for example, which could be one driver of this. Otherwise, no gender differences, except for in Bangladesh, where women actually had higher success rates than men. We also looked at the time costs, where we converted the time it would take to achieve a successful transaction with the wage rate. And we see that this cost is much higher than the monetary cost. So customers, this takes together reliability, so success rate of the transaction, agent present rate, and shows that the time cost is high.
Lina, you have 5 minutes.
So I'm going to conclude with our key takeaway. So price transparency is an issue. And like we heard today, that the kind of structure of high withdrawal charges but zero fee on deposit charges keeps the money inside the system. In terms of our mystery shopping work, so verbal disclosures of prices are rare. Overcharging is relatively common in Uganda, and this is a huge problem for financial inclusion. Rural areas often agent overcharge more, and present and success rates are also lower in rural areas. Okay, that's all for the finding for transaction index. So quick in the end, if any of you are interested in measuring transaction costs in this way with any of our methods, we have a toolkit which you can access online, which details different methods and also implementations and our survey tools and methodology. Thank you a lot.
Thank you so much, Lina. So we've had 2 papers, one that discusses interoperability and the fact that it results in lower prices, yes, but a reduction in investment. And the other that looks like in Uganda, there's a lot of overcharging, especially in rural areas and where agents are concerned. Happy to receive any questions from you. I see 2 hands so far. The gentleman here, there's another gentleman there. You can start with him.
Hi, this is Andrew from the IGC. So I just had a question about the interoperability paper. So the policy suggestion that you had is subsidies to rural telecoms. I mean, I think often in these kind of policy contexts, it's not super realistic. So are there any competition policies or other sort of regulatory design policies that could be an alternative? And also, could satellite technology, you know, we know that Starlink is starting to make an appearance in East Africa. Could that be a game changer to this dynamic? And also, just last thing is there's a lot of efforts now underway to try and increase cross-border payments interoperability. Do you think that this kind of dynamic, the trade-off between competition and fees would exist in that context as well?
Thank you very much. Mine is to the first presenter. I appreciate the paper, very timely, looking at you know, the trade-off between the interoperability, competition, and infrastructure investment, especially in the underserved rural areas. However, just like the speaker, the one who had, I have a few questions. You highlight this trade-off between interoperability and rural investment, but how do you account for cases where interoperability has increased the transaction volumes and thus total revenue for providers? And the other one is, to what extent do mobile money revenues actually drive decisions to establish rural towers given that there is also the voice and internet data that generate income to telecoms. Lastly, could you think about other tools? And this is in line with what my colleague has asked, such as the tied licensing or infrastructure sharing that can complement subsidies to support rural investment. Thank you.
My name is Joseph Keller, and I'm from Uganda Revenue Authority. My question goes to the first presenter. And a few years ago, I think there was a tendency, a policy by I think UCC for farms to be sharing masts. So that actually led to a reduction in construction of new masts, probably in the city centers and upcountry. So the cost that you talk about, a reduction in cost, how do you relate that to that kind of policy? And then two, these are farms that are alike. I mean, these telecom companies are similar, they belong to the same structure. How does that affect the kind of results that you have? Thank you.
Okay, my name is Jimmy. I'm from physics department. And I'm here to, yes, you know, digital payment is a reality. And mobile money, on this case we have is, we know that deposit is free, sending fee is cheap, and withdrawal fees is very high because of taxes involved as well. But initially we know very well that the transactions were fewer when this mobile money infrastructure started. But now we have a huge transaction taking place. Is there no algorithm somewhere in the networks, in the big players, which can be used to reduce costs? Because it's also affecting the local. You are free to deposit, but you are not free to remove it. These are big, big challenges. I think the two presenters for these two papers can have a case. You talked about subsidies, but I think these towers can be constructed and they can subsidize and also provide them using some solar power. And solar power, you know, is free. There is only up cross cost. The maintenance will be good. So I think even in future, these towers should be using huge solar powers to reduce some of these costs to the local. Thank you so much.
Thank you all for the very insightful questions. It's great to have this conversation. And you know, Lorenzo and I have been working. I didn't say that this paper is co-authored between Lorenzo, myself, and Marcus Brunnermeier at Princeton. So let me take this moment to thank them for this joint work. Let me try to answer in detail. Regarding whether rural telecommunication subsidies are realistic, they exist. So it's not we invented them. So they exist, and you know, they have been used. So we see that wherever rural telecommunication subsidies were handed out, that countered the decline in coverage. So, but there could be better things. You could, for instance, have some degree, I mean, think about it at the end of the day. Interoperability is gonna favor customers. So, you know, companies would give up some rents. You would want a mechanism that redistribute rents away to the companies, bringing them on the participation constraint so that they keep providing the service. So you could think that taxes could be a way to go for it, or that companies bid in auctions to provide this service. That seems very plausible. Complicated, but plausible. On cross-border and transfers, we are working on it. Cross-border, I mean, the mechanism is always the same, right? Monopoly power versus extensive margin. So there is something we are working on those lines. Cross-border is much more complicated. In fact, I look forward to hear from practitioners because, on top of all that we've been discussing, there are foreign currencies in the middle. So, I mean, it's great that there is work on this. For many years, I was going around academic conferences shouting alone. So now it's good that there are people interested in these topics. Second, now, yeah. So the second question was about, well, but is mobile money so relevant for towers? We don't really have that much data because for many mobile companies, they don't separately report the revenues from mobile money and the revenues from mobile networks. Some do. And I think the largest 4 or 5 in Africa. And that's all the way between 60% and 20%. So mobile money before interoperability was quite lucrative for companies. And you can ask policymakers, but I'm sure they will be, that's so in a sense, can the shock we are studying have effects on towers? Even 20% or 10% of the revenue is a large share, especially in some areas, in poorer areas, where people are mostly receiving payments and cashing out. Fees make a big part of the local revenue. Of course, it would be very interesting to have detailed tower level data on local revenue and local cost, because that's basically, at the end of the day, what a regulator, central bank, Ministry of Telecommunications would be interested in. Now, question about, sorry, the last question on solar power. I love it. Okay, we all love solar power. It's clean, except if we think of all the pollution created in extracting all the material producing it. But forget about that. There are some solar powered towers in Africa. Very few. Very few. Why? Well, you need a lot of land for that. Many of these towers are in areas where land rights are not clearly assigned. And you need a lot of land to power a tower. So it's really, I know that if we think about, solar is good, everything is going to be solved by it. I'm really struggling. Also because you put in a very isolated area a large solar investments, who takes care of it? So I'm not sure, while the operating energy costs of solar power may be declining, I am not sure the total operating cost would be declining. So, let's try to be very focused about these effects. So, actually, I have a question for the other paper. I don't know if I can, Okay, very good. So I'll shut up. The last question. Oh, very good. No, paper is very interesting, and we need better data. We've been interacting with Javier and with Francis. We provided feedback on how we did our Wayback Machine, so it's great. The mystery shopping is very, better data, more data is important. I wanted to ask about overcharging. Overcharging is ugly, and no, banks are heavily fined if they charge you a price relative to another one. I would like to know how large is that? So what fraction of the fee is imposed? Because, maybe overcharging is just a rounding mistake. It's 5.5 and I tell you 6, because maybe I have cash problems and I don't have the remainder. So how large is overcharging relative to the fee? And also, maybe it sounds nasty, but would overcharging be efficient? Which is, suppose there is a total ban on overcharging. Would those agents providing that service stop providing the service? Would it be better or worse for customers?
Okay. Thank you a lot for those questions. As to overcharging, so we separate between, so we have the official provider fee. So the overcharging is essentially a cash fee that is imposed by the agent extra on top of the provider fee, which is automatically deducted. All right, so as a percentage, of course, for the lower the amount, the higher the percentage. I think it's not huge, but especially in rural areas and for low transaction amounts, I mean, it's going to make a big difference. As to, sorry, what was the final point? Oh, right. I mean, the agents, they earn commissions, right? So they earn commissions they represent the telecom providers. So they represent Airtel and MTN as a point of service. So they already receive commissions. So these extra fees, I mean, mobile money markets in Bangladesh and Tanzania work just fine, even without high levels of overcharging. So it's a good question. I would probably say no, that this is a glitch in the system which is not sufficiently enforced. Also that there is no proper redress mechanism. We are currently doing another study in Uganda, and we show that, I mean, customers don't seek redress for overcharging. So maybe this is something that the telecom provider should step in for.
Okay, please a round of applause for our panelists. And to thank you so much for the presentation.
Hello.
Please feel free to reach out to them at lunchtime.
Excuse me. I have a question.
MC, can we take the question?
At your discretion.
Yeah, thank you. My name is Jackson Nyabanawe. I work with a fintech called Flutterwave Payments Technologies. And my question goes to Lina and Anthony. Thank you so much for the deep insights that you've given us regarding the transaction costs. It's really a very sensitive area that is very key in driving financial inclusion in Uganda. I don't know if your paper was specifically focusing on cash in and cash outs at agent point of locations, but we also understand that there are many players that are engaged in different transactions from different digital financial services. For example, if you want to access purchases online, you also have to either get charges on either you're depositing or withdrawing, or doing bank to wallet transactions, you still get charges. So my question in that respect is that what are key recommendations in this case to policymakers, mobile network operators, and digital financial services providers in making sure that they reduce transaction cost, but as well strike the balance on increasing financial inclusion both across the country? Thank you.
Thank you so much. I think when we look at the recommendations, when we look at the recommendations as a way of curbing overcharging, one of the things that we notice is that throughout our field work, the different, when we're doing this kind of data collection, you notice that there is a need for for agents to have to be accountable to either the MNOs or the government, because you notice that whenever a customer is overcharged, then they do not have where to report, and they do not report. Just like Lina said, there's a study that we are carrying out currently. They report overcharging, but then there's no one who has sought redress. And one of the reasons is because they don't feel like they will get they will get a fair hearing. So one of the recommendations is, to have agents being accountable. I know we have had MNOs, say, please do not accept to be charged an extra fee. But I have not seen even people here in the room can attest. I don't know whether anyone who has been overcharged has had the opportunity to report that kind of act. So there is need for, active enforcement of some of these regulations from the ecosystem. And of course, also the customers to be on the lookout to report such kind of tendencies.
Another round of applause.
Thank you, Dr. Anthea. Can we please give our panelists and our chair another round of applause? Thank you all for being very active participants. I was quite shocked that I didn't get any comments from MTN or Wave, considering that you guys were actually discussing their fees and transactions. But I think that is a discussion for lunchtime. Mr. Photographer, please let us. Ladies and gentlemen, if you still have questions, this engagement is online. Please send your questions in to BOU official, to IGC, even to Macquarie School of Economics. We'll make sure that we'll try and get back to you as soon as possible. All right. Thank you so much once again. Ladies and gentlemen, we've come to the close of the morning session. Please note there is a session 3 happening in the afternoon, beginning at 2 sharp. The earlier we start, the earlier we're able to conclude. If you have not registered online, please remember to as well, and pick your Leonard. So now I'm going to release you for lunch, ladies and gentlemen. Lunch is where the break was served, the tea break was served. Please note that I would request it if we are all back here by 2 sharp. It will help us finish on time. Once again, thank you for your active participation. Thank you for your questions. See you all at 2 p.m. sharp. Thank you. considering time constraints, we'd like to get started as soon as possible. If you find your colleagues outside, please tell them to come in. We are starting the afternoon session, also known as a penultimate session. Ladies and gentlemen, please allow me to invite our session chair for session 3, Mr. Hannington Musimenta. He's a senior economist, monetary and external at National Planning Authority. Please give him a round of applause. Hannington will be session chair, and he'll be in charge really of the next hour and a half that we have. The theme for session 3 is bridging the digital divide, infrastructure, policy, and inclusion in East Africa's financial ecosystem. Please allow me to invite Andrea Filippo from the IMF. Please give him a round of applause. I was going to struggle with the last name, but I think we'll just be fine with Andrea. Andrea will be discussing mobile internet, collateral, and banking with his paper. Our next presenter will be, sorry, I need to confirm on this. Digital finance policy and its impact on financial inclusion in Uganda, with Nicholas Okot. Do we have some presence here? Nicholas, please. So this paper was authored by Nicholas Okot and Elizabeth Kasekende of the Bank of Uganda, which is why I've gone into a lot more detail than usual. Ladies and gentlemen, my name is Ralph, still your MC. Please do not hesitate. If you have any questions, just reach out and I'll be able to handle them for you. Mr. Chair, I'd like to hand over to you. Thank you. You're very welcome, Hannington.
Thank you. Thank you, the MC, for the opportunity, and I welcome my panelists and everyone from lunch. We are going to have a discussion on bridging the digital divide, and what is guiding our discussion has already been talked about. Part of how we are going to do it, we are going to have 2 presentations. We are supposed to have a third one, possibly it will come through digitally, but if not, we shall have these 2, and it will facilitate our discussions going forward. I want to note that from as early as 1987-97, Uganda started the process of going into the issues of digital currency when they passed the policy on ATM and other things that have happened along the way. To be precise, in 1999, when we had a policy on the use of ATM and others, we started on that journey. But to discuss these key topics today, we have 2 colleagues that have been introduced, and we are going to start with Andreas to discuss the first paper that we are going to discuss for the day. The paper that Andreas is going to present today is focusing on mobile internet, collateral, and banking. All of us know that one of the issues we have around access to credit, access to banking services is collateral, and then mobile internet comes on board to bridge the digital divide and increase access to money by increasing access to mobile banking services and other financial intermediation or services. Allow me to invite Mr. or I don't want to use professor, I have already read a lot, but let me invite Andreas Plestibero to discuss the first paper. You have 20 minutes, sir. Thank you.
All right, so while the slide comes here, first of all, let me thank the organizer for inviting me to present the paper here. So, as it's been said, we switch a little bit gears with respect to what we have been saying now until in the morning. And so we're going to talk about the role of collateral, and particularly the intersection between mobile internet and collateral in allowing people to have access to banking services. So what we're going to discuss is on the one hand, the arrival of digital technologies, and that's why the paper, I think it's a good fit with this conference. So how mobile internet allow people to get better access to banking services, specifically transition from microfinance to banking. And also we're going to dig in on one specific mechanism that allow people to do the transition, and that mechanism is exactly the use of collateral, and we will see that the use of collateral is make it easier exactly by the arrival of mobile internet. So this is joint work with a number of people who've seen here, and including Nicola, who presented this morning. And you know, some of us are from institution, I'm from the IMF, so the usual disclaimers apply. We also change, a little bit from the morning, because this is a paper not on Uganda, but a paper on Rwanda. So the setting is slightly different. As I said, meaning that the overall overarching theme is that internet technologies can be particularly powerful to sort of foster the development of financial markets through many different channels. One is clearly information provision, so individuals know more about their options, the banks, and the financial products which are available. Information flows much more easier across people, and third party can validate some of the assets. And these are generally issues that are valid across different potential aspects, but one specific aspect which is listed here is also the collateral. So the collateral channel is important, and you know, acquisition of collateral made it easier by internet technologies. The use of collateral is also easier if there is much faster information flows, and also the fact that banks can actually verify the collateral can sort of make the collateral more valuable and much more usable in transaction to get access to finance. All this is particularly important in the context of low and middle income countries where there are weak institutional setting and, more important, tight financial conditions, financial frictions. And you know, there is a lot of literature, a large literature on that, and it's important sort of to make the case that some of the benefit of mobile technologies can be particularly important in a context in which the institutional setting is weaker, and more importantly, there are a lot of financial frictions. Therefore, like the internet can make information flows much more efficient. Oops. So our research question, as I said, we want to, it's very simple on the one hand, so we really want to understand how mobile internet can make access to banking and banking services much more easier in the context of a developing country. And then we want to dig into one mechanism, and this mechanism is the complementarity between the technology, so internet, and the law, the collateral, and we want to see how this complementarity can actually be a channel through which mobile internet can facilitate access to finance. So as a disclaimer, you know, we have been hearing a lot about mobile money and digital payments and all that. This paper is not about that. So some of you will be unhappy about that, but this is not a paper about mobile money. It's a paper about internet technologies and banks and microfinance institutions. As I said, we focus on one country, Rwanda. We look at over a relatively long period of time, 2008, 2015. At that period of time, in the middle of that period, two big things happened, which are important for us. Oh, you're still there. One is that there is a arrival of the internet, and second is that there is a reform, there is a land reform which established the possibility of using collateral to get access to banking. So we have a lot of data in the paper. I will spend a little bit of time on the data that we have. We have some nice way to identify shocks. So we use variation in the availability of the internet technologies, and then we use this land reform that introduces a digital registry for land, and then make it possible to use collateral. So let me guide you quickly through the results and sort of the story that we have in the paper, our narrative, and then we'll dig a little bit deeper in some of the results that we have. On the one hand, what we find is that the moment mobile internet arrives in the country, that leads to significant changes in financial decisions that people make. Overall, we don't find any effect of financial inclusion, but under the hood, there is a lot of reallocation. And what we find is that basically people are much more likely to take up bank loans and much less likely to borrow from microfinance institutions. So there is a switching from microfinance to banking, to some extent is a transition we want to see in countries the moment they grow. We want people to get access to formal banking services because they come generally with larger amount, lower cost, and more possibilities for growth. So we actually document this switching from microfinance to banks, and we see that that comes exactly with advantage. We see that people who switch get larger loans and they get cheaper loans. And then in terms of mechanisms, we show that this happens in part, not entirely, but in part through these collateral channels. So we can see that the land reform, together with the arrival of the internet, make it possible to make it larger, the market for land titles. So there is much more negotiation of land titles across people. Transaction cost goes down. And we can see that there is much more use of land, which is used as a collateral. So there is an increase in mortgages. And that sort of translates into better access to bank, because people which before weren't able to access to bank because of lack of collateral, now they can use land parcels, they can use land as a collateral, and therefore they can access to the banks. And we can see that this is basically a large effect. It's explained something about 30%, if not more, of the increase that we see in access to banking services. So, as I said, the setting is Rwanda. We use different data. We have especially the credit reference bureau. So we have loan level data from the National Bank of Rwanda, which covers banks and microfinance institutions. Therefore, we are able to look at this switching. It's very rich. We have information about loan rates and loan amount. And we know a lot of information also on the borrowers. And overall, we are able to put together a database which includes more than 110,000 unique borrowers in the country. Then we have information on GSM coverage across the entire municipalities in Rwanda from 2008 to 2015. And then, since we care about land transaction, we work together with the Rwanda Land Management and Use Authority to have information at the municipality level on land certificates, transaction of land certificates, and the share of land which is actually used for mortgages. So let me spend just a couple of minutes on what is going to be our identification strategy. So where are the variation comes from? Because we know that the moment internet arrives, this is generally correlated with economic opportunities, and therefore whatever we find in terms of access to banking is potentially driven by reverse causality and endogeneity concerns. So it could be that we see more banking activity and more internet simply because the two things happen at the same time, because these are the area of the countries which are better opportunities. So for that, we need to find some sort of exogenous variation. This is basically Rwanda at the beginning, at the end of our sample, and this a map of the intensity of 3G. And you can see that there is a pretty widespread use of 3G. At the beginning, it's just concentrated in the few urban areas, and by the end of the period, is much more widespread. Some areas are clearly not very populated, so there is not much internet even there. So generally, we want to estimate regression in which we're going to look at some measure of like access to bank and access to microfinance as a function of how much coverage there is of 3G technology, so mobile internet, in a given municipality where the borrower lives. So where is our source of variation? We have two different sort of shocks. One is lightning strikes, and so we have information of how frequent lightning strikes are in the country. And there is literature telling you that clearly these are correlated with the potential use of arrival of 3G internet, exactly because it's the lightning strikes much more costly and make the technology much less efficient. And the other one is incidental coverage, which again exploit the fact that depending on where you are in some part of the country, you can be more or less close to the electric grid. And also the geography really matters, because we all know, I guess, that Rwanda is called the country of 1,000 hills. And so depending on where you are on the slope of the hills, then the signal transmitted by the tower could come in a better way or in a worse way. So the actual access to 3G actually depends on the morphology of the country and actually on how close you are to the electric grid. So these are sort of sorts of variation that makes it that allow us to get some identification. And this is exactly what you see. On the left-hand side in blue, you see the intensity of lightning strikes, which is clearly closer to the western part of the country. On the other, you can see this variation in incidental coverage, so how close you are to the electric grid. And you can see that this is very different. So the two charts are very different. So they pick up different potential sources of variation. And they're also somehow exogenous to what you think about economic activity, especially if you look at the lightning, you can see they're not specifically correlated, for instance, to the degree of urbanization of the country, which is a good proxy for economic activity. So we do that. This is our source of identification, and that's what we find. First of all, this is the first result that I told you. If you look at the probability of borrowing, that's the first column. There's no correlation between the arrival of internet and the probability of borrowing. But if you unpack that probability with the probability of borrowing from the microfinance vis-a-vis the probability of borrowing from a bank, you can see exactly that there is quite a lot happening. So the moment internet arrives, people are less likely to borrow from microfinance institutions. At the same time, they are more likely to borrow from banks. These are relatively large effects. We're talking about 3% change in the probability of borrowing, even more than 3%. So there is this shift from microfinance to banks. And then we can also specifically look at the transition probability. So the probability that you switch. So we can look at specific borrowers, at the one who were borrowing from microfinance, and we can look at the probability of switching from MFI to banks, and also we can look at the opposite probability from borrowing from banks to MFIs. And here you can find again the same results, but if you want on a sort of a much more precise way. Again, higher probability of switching from MFI to banks, lower probability of switching from banks to MFI. So there is basically a shift of the people who were borrowing from MFIs and more getting loan from banks. So how the switching comes? So which are sort of potential advantages of switching from MFIs to banks? Here we can see the results, and we can see that generally when people start borrowing from banks, get larger loans vis-a-vis what they were getting previously from MFIs. This is shown in the first column. At the same time, they also get a premium in terms of lending rates, so they pay less. And again, the effects are larger. It's more than 2%. So basically, they pay 220 basis points less the moment they switch from MFI to banks. So it's more quantity at a cheaper price. So it's better for them. Then you can think, okay, but then these are basically just riskier people that they desperately need more money because maybe they have, they're more need, they are exposed to some kind of shocks, or maybe they're more entrepreneurial and so they are more likely to fail. And so we wonder, is this the case that this switching also comes with a lot of default? If we look at the last column, we can look at, the share of the probability of the loan being in past due, and nothing happens. So these are basically good borrowers. Their probability of default is as similar as any other borrower. They just move from MFI to banks. They get more money at cheaper price. So it's sort of a good story coming from the mobile technologies promoting sort of access to finance. So what's the channel? The channel is said it's the collateral. And so why it's important and why we think that the collateral may matter in this story? Because generally there has been a lot of literature on microfinance, say microfinance is very important because they allow to overcome informational frictions, because there is somehow a social collateral. Think about group lending. We all take a loan together, we all know each other, and so the fact that there are very strong ties within a village, within a community, that's exactly the kind of collateral that the bank needs, because everybody is basically some sort of guarantee for all the other that take up the loan. Clearly, banks don't do anything like that. So there is no social collateral that come with lending to banks, and so banks need a real collateral, a physical assets which can be posted against the loan to provide information. So it's one way the bank used to overcome informational frictions. So that's the idea we have in mind. We think that this transition could be easier if there is a collateral story behind that. So then we look a little bit at what was happening in Rwanda at the time in which we found these results, and we actually learned about this land tenure regularization. So it was a reform launched between 2008 and 2010. It was a very successful, is sort of taken as a good example in a lot of policy reports, like what we quote here in quotation mark are some statements from a World Bank report, say it basically was able to have digital record for over 10 million land parcels in a very small country. So it means it's covering the the entire country. And also there is a digital mortgage registry, which is very important for us because our story is about internet, it's about technology, and so we want a registry to be digital so that the banks can access that information digitally through the internet and not through walking to the registry and getting information on paper. So it's a story that has to work through technology. So we get all these data and we can try to do some tests. So that's exactly what I told you now. So the connection goes, mobile internet makes land titles easier to use because people start to know about the reform. We have evidence in the paper, anecdotal evidence that the internet was very important for people to be aware of the fact that it was a reform. So land titles, people knows about that, they can start trading them, then can be used as a collateral, and then the collateral make access to bank easier. As I said, a key element is that all the banks in the registry have access digitally through the registry. So they can actually verify the information. You can look if the collateral is valuable, how much is valuable, and that's exactly what enters in their decision to extend the loan. So let me guide you through 5 steps through which we think that the collateral is really important. First of all, we need to see that this reform was not something on paper, but the reform actually matters. And here is data taken from doing business. Here on the vertical axis, we plot the number of days that it takes to register a land transaction. You see Rwanda, before the reform, was doing very poorly. It took close to 400 days to register a transaction. Then there is the reform. The reform are the 2 dashed lines, the beginning and the end. And you can see that if you look at the transition from before the reform to after the reform, Rwanda moved from being the worst performer or one of the worst in Africa to be one of the best performers in Africa. So it became very fast for them to register transactions. So the reform was effective at changing the status quo. First thing. Second thing, does that really translate into actual more transactions? So here we look at similar regression as before. Is the arrival of internet correlated or associated with the number of transactions? And you can see that in the district in which, in the municipalities in which there is easier access to 3G coverage, 3G internet, those municipalities, those districts in the country are the ones that register more transactions in land titles. Okay? And they're also the ones that do it faster. Then this is basically just the fact that people start transacting in land titles. But is this used then to access to credit and mortgages? First of all, yes, it's the first column. In the district in which there is the internet technology arrive faster, there is a higher share of land which is used, which is mortgaged. So land is used more for mortgages. That is done, as you can see from the number of observations, at the municipality level. We can go back to our credit registry and can see the probability of a bank loan is collateralized, and also the probability of having a mortgage. And in both cases, for people who live in areas in which there is easier access to 3G technologies, then these probabilities are higher. So it's much easier if you are, let's say, in Kigali when internet arrived earlier to get a collateralized bank loan or even to get a mortgage. And finally, we also have some other evidence that goes one step further to take it's not just about access to finance through collateral, access to bank finance through collateral, but this kind of spurred also the construction market. So people use land as a collateral. There is a lot of mortgages, but that actually translates into the developing the construction market and the real estate. In the last column, we use satellite data on building volumes. And what you can see is that this idea of having more land which is used for mortgages is actually translating into more building volume, more construction. So we argue that this is a channel that also allows for having a little bit more of the development of the real estate market. And I'm done. Oops. Let's say that I'm done. This is the final point. We want to quantify how much of the transition from microfinance to banks is actually driven by the collateral channel. And so that's the story. So first of all, I told you from mobile internet to banking. Now, and then I told you the mobile internet go through land titles and go to banking. How much is the effect that is mediated by the collateral channel by land titles. We do different exercises in different papers with different methodologies, but here I want to give you the bottom line. The bottom line is that about a third of that channel is driven by, about 1/3 of the transition from MFIs to banks is driven by the collateral channel. All the rest is residual and makes sense because, as I said at the beginning, the moment internet arrives, it brings a lot of good things to a country. People tend to become richer, there is more demand, they will demand more bank loans. So part of the transition is driven by anything else which is not collateral. 1/3 is the collateral. The interesting part is that if you look at the far right bars, if we only look at collateralized loans, then the effect of the land title and the collateral is actually 80%, which makes sense and further strengthen the interpretation that the collateral channel matters. And with that, I conclude. So the story is about how technology can shape financial choice and make people for people easier to access banking services and banking credit. And we say that mobile internet is clearly a strong enabler of this transition, especially when it's together with a reform that allows the collateral to be used by the bank to access to finance. There is a lot of sort of implication for policies about sort of developing collateral markets, developing real estate and all that. But bottom line is a story about how mobile internet can overcome financial friction. I'm done. Sorry for the heavy
A round of applause for Andreas. Thank you, Andreas, for the presentation. It makes me think that we have 19.5 million Ugandans that have access to internet as per the latest Uganda Communication Commission's report. However, only 32% of our land as Uganda is titled, with only 5% of the population having proper documentation for the land they own. So the transmission mechanism that Andreas has emphasized, we need to critically think about it as Ugandans on how you move from mobile internet, 19.5 million people, to land titles that is then collateralized and then improves access to finance, or it makes them bankable. I also want to note that even when our land reforms are not very clear, we also have a land reform that has taken place, and you can equally do a search of a land title and other things digitally. So as we think about the recommendations and the issues raised by Andreas, we need to relate them closely with our country's context. And without much ado, I want to invite Nicholas Okot to also present a paper on digital finance policy and its impact on the financial inclusion in Uganda. As I noted earlier, the process of digital finance policies that are related to digital finance stem back to 1997. So I invite Nicholas to take us through that journey and its impact on financial inclusion in Uganda. Nicholas.
Thank you, moderator. As I wait for the slide, it's a time to greet you people as well. Thank you for the good presentations we have had today. And we'll take you through what we've done on this paper. And of course, welcome a lot of comments and feedback from you. I'm an alumni of Makerere, and I'm grateful to come back to Makerere after a long period of time, and happy to be at this main hall as well. So this is the work. This work has been going on for quite some time. It was part of the project that we are doing to understand the impact of digital finance on market development in East Africa. To the project, part of an ARC project funded by the Bill and Melinda Gates, and we participated in it jointly with my colleague, Elizabeth Kasekende. The title of our paper is Digital Finance Policy and its Implication on Financial Inclusion in Uganda. And we try to distill from the policy perspective as you're going to actually look at it right now. Still not getting my gadgets right. There we go. This is the content. So we'll broadly cover a bit of introduction, why we wanted to do this work, our motivation for doing the work. The details are actually in the paper itself. I will provide a bit of background and context in terms of the literature. This is a growing area, and we expect that lots of literature is still going to come up as new data comes on board. So we expect a lot to come there, but we'll still provide what was available at the time of the study. And then, of course, we go through the methodology and then the results and finally the recommendations that we have. So in terms of introduction, we note that Uganda has witnessed a big revolution, as many of the countries within the region, in terms of digital finance uptake. And this was largely driven by mobile money, as you know, the retail part of the digital finance. Of course, internet banking and other options came up much later, but digital finance was largely driven by the mobile money, and of course the fintech companies producing products that could actually help to drive the mobile money systems. However, we note that at the beginning, it just began like a story because our neighbors are doing it. We should also get on to doing it without having a policy. Those of you who work in the digital finance ecosystem, like the service providers, you know very well in 2009, we had a small note that helped us to actually join the system. So as a whole, we have a number of entities involved in the digital finance ecosystem or else in that space or industry. But we don't have a unified policy. So we have some scattered sets of policies here and there, and those are the ones that actually try to guide us. But it is good always to have a unified policy. And that is something that we could work on as part of the recommendation from this paper as well. Now, we also note that the advance in of course, ICT has improved the use of digital finance services. In 2009, as I said earlier on, mobile money came on board. There was just a guideline written to actually allow MTN Mobile Money to actually run. Subsequently, other service providers came on board. And we have, since that time, enjoyed exponential growth in uptake of these digital finance services, both in terms of the people or the users joining in or registering for it, but also in terms of the number of transactions that are being conducted per day. So when you go on to where the website is, all right, thank you. I understand I was a bit far from the mic. I thought it was picking me up. So, we've noted exponential growth when you look at the statistics, and it shows that both in terms of the uptake, people registering and having active mobile money accounts or active bank accounts for online banking and so forth, but also in terms of the volume of transactions that we have been receiving. So number of transactions now put down online, and that has also facilitated to some extent e-commerce. Of course, with that comes in the value. The value also keeps growing, and when you try to plot the data, which is usually provided by the team from the payments department, you can actually note that there's been an exponential growth in mobile money uptake and digital finance services as well. So what motivated us to do this study? We wanted to address about one or two research questions, and that's, I think, what really drove us to this study. First among this was to try to establish the impact of digital finance policies on access and inclusion. Definitely here, our thought process was that there's likely to be a dual causality or two-way causality, but we want to first investigate from one angle and see whether the causality is from the policy to the uptake or from the uptake to the policy, and then try to see whether there's also a dual causality in both directions. And then the other question that also motivated us was that, are there financial policy changes driven by digital innovations? So are innovations causing the changes? Are innovation driving changes? Yeah, this could be still seen visually, but you still need data to actually confirm that this happens very well. Now, because we didn't have enough data on everything at the time of the study, we had to rely on one study that uses cross-section data. Now, to supplement that and to get more insights from policymakers, we did utilize an household level data set that are based on actually key informant interviews. So we did talk to informants who knew a lot more about a lot more about the sector to provide for us more insight beyond what you could see in the cross-section data. So what was our objective for this? The objective was basically to of the study was just to examine the impact of digital finance policies on financial inclusion. So we're now coming from the other side, how does policy provided the environment or the ecosystem for financial inclusion, for digital finance services to actually thrive in this country. And here we use two approaches. The first approach is to use econometrics based on the treatment effect model that we employ on a cross-section data based on a financial inclusion survey that was done sometimes back. The second approach is to try to interface with policymakers, and here we use a key informant interview to get an in-depth opinion on what's going on, because the numbers are shorter in terms of the timeline, but they are huge in terms of the cross-section. So we want to get a bit more of the time scale on what has been coming through in terms of the time and how policy has evolved over a period of time. As I will show you, we interface with both the users, the associations, the service providers, and the policymakers as well. Yeah, in terms of background a bit, going back to the background on Uganda, I know you've had a lot of discussions on this and probably also had a lot of your time to read. Digital finance inclusion has been quite important in terms of formal finance inclusion. It has driven us from about 28% in 2009 to now 58% in 2018. And when you look at the latest FinScope that was provided in 2024, targeting the period to 2023, you actually find that we have actually gone to the level of 64-65% formal financial inclusion. And this, of course, is largely driven by the mobile money services, because at the moment we don't have a digital central bank currency, so we rely on the mobile money services for the transactions. But there are also a few agents who have bank account, as you know, about 12% of the population, and they also have options to actually use online banking apps and so forth. So we provide a small definition here, which I'm not going to go through it, but just encompass this, the digital finance, the way in the context in which we are using it is just to encompass the use of transactions, using it to access credits if you want to have credits, and then therefore making repayments when the time for repayment falls due, making transfers. Many of you work in the city or else away from your own home states, so you do make transfers across districts, but also across border. There's also a lot of transfers that takes place, and that's how DFS has actually tried to enshrine itself into the community. In terms of literature, as I said in the beginning, literature is really growing, and there's a lot of opportunity for those of you who are PhD students or those of you who are interested in the policy in this area. There's still a lot to do research on. The new data sets are coming, and they keep coming every now and then, and that should provide you an option to do an in-depth study. But we picked out a few studies that were available at the time. And for instance, we note that digital finance is believed to drive improvement in access to financial services and inclusion. And this is largely spurred by an increase in interest in the financial inclusion. So people become more interested, sometimes because it's easier and it's cheaper to actually operate through a digital finance platform. Those of you who've been to the countryside of Uganda know very well the brick and mortar banks or the traditional banking systems are not spread all over the country. In some parts of the country, you can drive for almost 100 kilometers before you can see a bank. So in such cases, the digital finance becomes the immediate option for agents to actually transact with one another. But of course, there are several studies that argue that digital finance also digital finance policy may also enhance financial inclusion while concurrently also promoting actually DFS itself. This is, of course, supported by a study of the World Bank and Barajas as well. We also note that in terms of the gender, women actually were disfavored a bit by the traditional banking system. And therefore, digital finance in the literature is recognized as a key driver in their participation in economic activity. Because for you to have a mobile money, you just need to have an handset. And once you have the handset, whether it is the old system or it is a smartphone, you can now begin to access the digital finance services, especially the mobile money platform. If you wanted to access the banking platforms, which are the banking apps and so forth, definitely you need internet and you also need a smartphone. But because many people are involved with the mobile money, they definitely have a larger access. And this has driven women to participate in economic activity, but also to keep money of their own. As you know, in certain cultures within, there are limitations on women owning and keeping assets of their own away from the head of the family. So this has promoted robust growth. As you know, women are very active in economic activity. They drive the growth of economic activity. They also promote saving and also try to invest in the right areas, not just throwing money up and down. But also it has driven the impact in terms of the rural-urban access. So traditionally, you have much of the financial services provided in the urban centers, but now here you have an option to actually interact with the financial services providers wherever you are, 24 hours, 7 days in a week, and that gives more opportunity for people in the rural areas to have access. And this is supported by a study done on China by G and his colleagues. So let's move in terms of the data. So to drive our study, we needed some sets of data. We needed to answer our question based on a set of data. So we decided, as I said at the beginning, to use a quantitative method first, and then we use the qualitative method to actually support the outcome from the quantitative methods. So in the first stage, we use an economic analysis using our financial capability survey data. The survey was conducted in 2020, and the survey had collected data on household information and their demographics, including income sources, digital connectivity, their financial strategy, whether they are capable of computing what it implies to have money now and money in the future, and so forth and so forth. But we also, so that allows us to have a huge set of data. It's actually a survey as much as close as possible to the FinScope that's done by many of the countries around the world. But this was purely intended at the time to see whether Ugandans were capable of managing their own finances on their own. And the questions were geared toward that. Fortunately, we also had questions that handled the areas of digital finance and access and issues around digital finance in terms of networks and so forth, and therefore gave us an opportunity to actually use it for that purpose. So we employed that data-rich environment and in a macroeconomic dimension. So it was a household survey, and the responses were provided by the household head. And that allowed us to actually use a treatment effect model to actually try to analyze and see what comes out of that. So let me first start with how the qualitative was done. So the qualitative was based on an analysis or discussions with a set of stakeholders, actually involving the two investigators, myself and Elizabeth, going to them and talking to them. Sometimes both of us, sometimes one person goes at a time. And this is the distribution of how we interface with them. 27% of the people we discussed with were policymakers. The other 27 were associations or think tanks, the people who actually support advocacy around digital finance services. And then, of course, we chose a larger sample from the industry players, including agents that are involved in actually transmitting the digital finance services as well. I won't go into this detail because this just defined the variable to take us through the econometric analysis. I'm going to come back to this aspect of the key informant interview when I'm now presenting the results. For now, I'm just showing you in terms of where the data came from. And in this table, we're actually showing you the data itself that we picked out from the financial capability survey and how we defined each one of them, and then in the context of how we made some treatment. You may note that some of the variables were changed into a structure where we could have them as binary choice variables or dummy variables, 1 and 2, so the 0 and 1. And in most cases, that to help us to actually do the analysis go in the right direction. So the variables are broadly an index that we created for financial inclusion based on an OECD framework that was set up in 2015 to do that. And then we have an indicator for digital finance as well. And then we take the age of the respondent, and then whether they are employed or not, what we're calling it a job here, and then whether they own a mobile phone or they don't own a mobile phone, that gives them the access to have digital finance. And then we look at the rural-urban setup in terms of a dummy, and then of course the indicator for financial capability, and then other features like digital security, information on products, whether they own smartphones, and whether they have done online transactions, and so forth, including of course gender. So this is the empirical approach. It is based on a simple set of model where we actually just impose actually one regression on another and then regress it. Such that in the first equation, we depict the determinant of financial inclusion, which is the outcome equation. Then ultimately, in the second equation, we actually now bring in the digital finance, which is an access to digital finance. And then we look at the implication on the parameters, as you are going to see in the output. And then we, of course, run them through the set of vectors of variables that I showed you in the other table. And we could not list them here, so we use X here as a variable that actually takes care of all those vectors that we looked at here. And therefore, you have the stochastic terms for both of the equations provided too. So the estimated equations in this context are the equation 1 and the equation 3. So in terms of the results, this is really a basic part of the result. I'm not going to discuss this as well. This is just how the numbers look like from the survey, the figures that we picked out, and how the counts are. And then, of course, we did a small test to just see whether there are differences between gender, and that contributes to any of these other variables that we are going to look at. And in most cases, except, I think, except 3, they're actually significant as well. Now, this is the main regression equation. We are here trying to estimate the impact of digital finance on inclusion, or rate on finance inclusion, and the impact of digital finance policy on the impact of digital finance on actually financial policy. Sorry about the use of the word inclusion up there. So here you have we have an index that I showed you here, the one based on the OECD. Let me just go back a bit to it. Yeah, so we created an index for financial inclusion up, the first item up there, and then we use it to actually regress it on the rest of the variables, and this is actually what you get. And our interest is actually to see whether what digital finance is actually is significant. And as you can note, in both the full sample and in the sample with female only and in the sample with the male only, it tends to be actually significant. We try to control for the rest of the other variables, including age squared, and whether someone is employed or not, and then the use of mobile phone dummies and other something, and capability and so forth. But we still actually do find that there's actually an element of actually a causality from one angle to the other. One point to note, when I was running these numbers, I ran them in move the data from Stata to Excel. So the standard errors look to be a negative. There's supposed to be a bracket, not a negative. Forget about the negative you see at the beginning of each of the standard errors. That tells us that we are supposed to put a bracket, but we didn't put the bracket in time. Probably, I'm going to correct that. Now, this is the outcome from the third equation, and this is the treatment equation, which we look at the digital finance, and then we look at the impact on each of the variables. And as you can see, in most cases, which I cannot go through step by step, we actually find that there's actually they are significant, and there's an element of causality coming from digital finance policy to actually digital finance or inclusion or uptake of digital finance services. So now we move to the other qualitative aspect. I showed you a pie chart which shows how the respondents were distributed. And then these are the main findings from that. They are largely written inside the text, but I think we can summarize them in a very short form. One of them is contribution of digital finance services to financial inclusion. Here we note from the key informant that digital finance enhances financial services access to the unbanked share of the population. It also promotes mobile money products beyond the digital finance itself, because you can now buy data, you can buy airtime, you can buy other things through the mobile money itself. It also facilitates transactions through peer-to-peer and peer-to-business, peer-to-government as well. Many of you have tried to pay government when you flout traffic rules. You can actually easily pay government through the digital finance space, but also you can pay the businesses through the Momo space, which we are calling peer-to-business as well. It does facilitate cross-border transactions. When you move around town, you're going to see M-Pesa, you're going to see agents for the Vodafone company of Tanzania. They're providing cross-border transactions as well. But it does have limitations, which the informants actually raise, and among these include there is low access to handsets. Handsets are still limited, while in areas like in Kampala and so forth, we do have easy access to handsets. In the rural areas, there's limited access to handsets and gadgets that are used for the digital finance services. We were also told that the cost and the taxes makes the services fairly high and deterrent to certain agents who have low income. This is in particular does affect more of the people who have very low income, because their relative share of the income that's affected by the taxes and charges becomes very high. The national ID was also identified as a problem because it's one of the key, they know your customer requirements, and if you don't have, you can't have access to a mobile line, and therefore you can't have access to a digital finance service platform, except maybe for the internet banking and so forth. So this also created a problem, and the replacement, I understand, takes quite a long period of time. And then, of course, the infrastructure has provided a challenge in terms of the communication network. And then we also note that the level of literacy among our people is still very low. People cannot even just remember the simple PIN or password of their own digital platform where they're accessing the system. Sorry. Let me look at one or two more factors very, very fast. The other factor is actually the influence, factors that influence uptake of digital finance services among women.
2 minutes.
Okay, which is one of the important part that also many people wanted to understand. And here we are told that women are more reliable users of digital finance services, such that once they join the platform, it's very difficult for them to actually leave the platform. There's a local awareness, increased awareness among the women, and this is usually driven by small women groups, even in the rural areas, talking between themselves, and then that keeps and brings the uptake of digital finance services very high. It also helped to provide social transfers. Many of us have parents, interestingly, women live much longer, so grandparents and so forth in the villages. Once you want to send money to them, you can actually provide that platform. They do have hindrances that affect women as well, and among them include social norms in our community. They make it very difficult for women to have certain assets. And then, of course, the low level of education and literacy among us women, low level of savings, women do not have a lot of income, and then the DFS is still not at the real forefront of women engagement, especially those involved in subsistence farming. Okay, so in terms of our recommendations, we came up with about 3 recommendations. They are highly actually provided for, well detailed in the policy brief of this paper. And here we note them to be like, one, they need to harmonize the legal and institutional framework such that it is easy to actually handle issues around digital finance services. There's also need to work around the competition law. The competition in the digital finance ecosystem is not well unified, so there's need to reduce the barriers that are created by competition among its agents. And then the tax regime remain a challenge. It's an easy option to collect tax if you're a taxman, but it actually creates a distortion somewhere else. So it is something that needs to be reconsidered. While we need to get some taxes from it, we also need to consider what impact the tax will have on uptake. And then there's, of course, the issue of cybersecurity, and locally for us in Uganda, we have the people we call buffere. These guys who call people, they actually call me as well, and they ask you to give you your PN or to send money to them and so forth. They actually do affect us as well. I think that's basically it. Thank you.
Okay, thank you, Nicholas. I want to thank you for the presentation. My question will be the last. I want to invite the audience questions on 2 papers. The first one that was presented by Andreas, and the second one that was presented by Nicholas. I see many hands up, but I want to start from behind. You give him the microphone. I want to start from the last line. Give the microphone to Dr. Niema, the last one this side. Then we come and conclude from here.
Thank you, Nicholas and your colleague, for the work. I read through the paper. My comment is more on the methodology and the definition of what is policy. You look at digital finance access as a measure of policy. I think that is a choice variable, which is not necessarily the policy. So I think there's need for clarity on what is it that you define as digital finance policy. Otherwise, we'll be confusing policy with what people choose to do by choosing, say, to use a service or not. And then the other thing is on the methodology. You use the full information maximum likelihood estimation method. And that requires that all the variables should be normally distributed, or there should be a joint multivariate normal distribution. I don't know if that is tested, Then the second equation where you have the digital access is a dummy variable, and it requires that the error term in that equation should be normally distributed, and it should be estimated via a probit. So I also don't see the results reporting that you have checked for those. And then again, with the methodology, you see there are a number of policies that took place from 1997 with the introduction of the ATMs, coming up to the mobile money tax, the financial inclusion strategy. So which policy are you trying to look at so that we can pin the impact on a particular policy? Otherwise, we have issues with identification. How can you identify that this is the impact of this policy versus all the other ones, which are all implemented and they are all working at the same time? So we have a serious problem of identification. Then also a number of variables that are included within the digital finance access, like use of smartphone, use of mobile phone, use of digital finance payment channels. Those are choices that are made by the people. In that way, they become endogenous, like to make your estimates identifiable. Again, when you look at, okay, thank you. Let me stop there.
Thank you, Doctor. Give it to Dr. Issa, then we move. Give it to the man who had the microphone first. Yes, I'm coming.
Thank you so much. My name is Johnson Biaruhanga. I'm a systems engineer. My question is about money lenders. Recently, the president said he wanted to ban them, but now we have a problem because we have digital money lenders. The question is to both of them. So, according to your policy and the context of Rwanda, which scope, what's the limit of your scope? Because you have a problem about the security of the money lenders. This person is online, I don't know them, but they say they can lend me money. I can just feed in my ID, national ID data. They lend me, they don't know where I am, they don't know me, but they believe I can pay them. So we have many frauds where the lender has been robbed, but the other cases where the person who has been lent has also been, their money has been something like that. So how can we regulate them or integrate them into the ecosystem? Thank you so much.
Thank you. The man in blue, in a blue shirt, before Peter. Peter and Daphne, you're the last ones. Eh?
Okay, thank you. Kasozi Mlindwa, I do independent consultancy in microfinance, tax advocacy. So you mentioned digital financial policy, as was earlier on alluded to by the previous speaker, and you do not tell us which policies you are referring to, because there have been policies that have been positive, there are those that were negative, and there were those that had even mixed effect. So you do not tell us that, and yet in your earlier submission you had alluded to the fact that there is no unified digital financial policy. And so borrowing even from the earlier discussion we had in the morning, when the rationale for making these policies is shaky, then the effect will always be mixed, and we will not be able to have certainty and predictability of the policies you're trying to put in place. So if you could kindly, and this actually applied to the mobile money tax, if you may call it a policy. So if you could at least break down for us so that we can get that nuance, which policies are you referring to when you talk of digital financial policy and the subsequent effect that has on financial inclusion? Thank you.
Thank you. Daphne, second row from the front here.
Thank you, Chair. I just wanted to bring the context down to Uganda. I know the paper was looking at Rwanda. I feel that in Uganda, where a big percentage of our population is informal and lacks collateral like land, this is just a suggestion and also a question, like how can mobile connectivity be leveraged to develop alternative forms of collateral? There's financial technology right now using alternative forms like digital transaction histories and okay, I know you mentioned group guarantees to improve access to credit. So I believe that would be a good addition to the study as well for the context of Uganda. Thank you.
Okay, thank you, Daphne. Peter?
Yeah, thank you so much. Mine will go to Andreas. I was wondering to what extent your results could be generalized to other countries, just like my neighbor here said, say Uganda, given the unique characteristics of Rwanda in terms of land governance, even the speed at which the digital penetration. I don't know whether your results can be generalizable, say for you to apply for Uganda or other developing countries, including the neighbor Burundi, for example. Thank you.
Okay, thank you, Peter. Nicholas, I says mine will be last. I also note that as we move through the paper, like most of the colleagues have said, the word policy disappears. It is replaced by digital finance, especially when you're defining your variables. So most of the colleagues, me inclusive, want to see the policy shifts from 1999 all the way through up to today, how those policy interventions have impacted on financial inclusion. So it speaks a lot on the definition of your digital financial policy variable. Let's start with Andreas, and then Nicholas will answer last.
Yes, no, thanks a lot. Meaning, let me touch upon briefly a couple of issues. Meaning, I think there were like a couple of questions related to the idea of how to develop a collateral and how can we make lending easier, and somebody touched upon like digital lending and the potential for frauds and such. I think what we show, and that also goes to the idea of how that is generalizable, is one mechanism, which is collateral, that could overcome financial friction. That's definitely not the only mechanism. So financial frictions are there, and you can. The idea is how can we allow people who suffer from information asymmetries to borrow from banks. So the story that we're trying to tell, and Nicole especially has a research agenda on that, but there are different ways in which this friction can be overcome. Clearly, technology helps, but can help on many dimensions. So one dimension we push here is that technology allows information flow, and if there is a land reform, if this collateral is there, land title is there, then the intersection, the complementarities between the two things, technology and land reform, can make the transition easier. It can make sort of people able to access through the use of land as a collateral. That's not the only way. Like in digital money, digital lending is a good example. In that case, you could have like different sort of information that can be tapped as a sort of way for the bank to know about you. Clearly, there are issues related to fraud, and it's something that really would like to study, and that's probably a call for like people here from Bank of Uganda or other banks. I'm very happy to partner on that. I think it's very interesting to study the market of digital lending. I know it's not working particularly well, but in theory, if you think about from a theoretical perspective, the bank can actually, through the digital footprint, can access a lot of information about the customer and can look at this credit history and how good they are in paying like their bills and such. So that's a good way, in theory at least, or under certain regulation, to overcome information frictions. So that's one way. Another way I would like to point, which was probably mentioned by Nafta when she talked about financial history, another way to overcome financial frictions is building financial history. So the collateral could say, okay, I don't have a financial history, but I have a piece of land. There is a registry. that's my collateral, I got a loan. One other way could be I can build slowly my financial history, and we have a paper also in Rwanda which we show that basically SACCOs were very good at allowing unbanked people to get the first sort of step into the financial system. With SACCOs, they borrow from SACCOs, they repay the SACCOs. SACCOs are in the credit registry, so banks see the clients are good, they borrow and repay, and actually we actually see some of those people which at some point want bigger loans. SACCOs are not able to provide those loans, and those people transition and switch to the bank. So that's another mechanism through which you can overcome information affliction. So here we are just pushing the SACCOs. The final point about how generalizable that is, yes, that's a lot which is unique about Rwanda, and the speed at which things has been done, the institutional setting. On the other hand, I would still say that a land reform could be done. There are other examples in which countries have been done. You just mentioned like some pretty stark numbers about how much the digital is working in the country and how small is sort of the sort of title land that there are. But still, that's probably an example in which there is scope to improve. But I think that's exactly because of that, some lessons could be learned. The final point, since we already have very few questions, I cannot one. Ming, I was very interested when you show some of your results, because you said, okay, there are men and women, and access to digital it's the same, more or less, for financial inclusion. Okay? But if you look at the probability of financial inclusion, one key driver, which only works for one gender and not for the other, is being employed. Being employed is very important for women, not so for men. It's kind of intuitive. Why? Because it's for men unemployed and all women not. But the interesting question would be, to me, one interesting question would be, does access to digital services make a little bit easier maybe for women to be financially inclusive? So the fact that they don't have a job, if they don't have a job, but at least have some digital services, that allows some of those women to get access to be financially included. That
Okay.
could be an interesting
Thank
point.
you, Andreas. Nicholas, you have another question added on the ones you had.
Yes, I will start with the, first of all, thank you everybody for the question that you've raised. It shows a lot of interest in the paper and the opportunity for us to grow the paper even further by adding on the insights that you've raised. But let me start with the last question raised by Andreas before I forget. So when you go to the estimation itself, you find a very interesting outcome. So the regression on the job, when we call, the word we are calling their job is defined to be employment, whether someone is employed or not. Now you find that the results shows that for the entire sample, or for the full sample, it is actually significant, and for the full sample, it drives by about 4%. By 4%, if one is employed, is more likely to actually take up what digital finance services. However, when you look at the breakdown in terms of gender, women and men, if someone could even flash it up, the first regression on table 3, you note that for men, it is not significant whether they're employed or not. So men seems to have income to actually join the digital finance ecosystem, irrespective of whether they're employed or not. While for women, they need to have digital finance services to actually be in the DFS ecosystem. And you note that is driven by up to about 7%. So about 7% of women who are employed are actually more likely to actually be in the digital finance ecosystem than the men. For the men, there is some small coefficient. Unfortunately, they are not significant, and we don't go in detail to discuss them. But when you read the paper, also you find that we made some discussion on that as well. And then as I go back to the other question from the floor, maybe I also, there's something that was raised, and Andreas has also tried to respond to, and that's the issue of providing digital finance as a platform for collaterals. I know many of you could have already tried to borrow, except maybe Andreas who doesn't live in East Africa. For those of you who live within East Africa, you've tried to borrow, and sometimes we started from getting an advance in terms of airtime. Then ultimately now we can borrow some amount of money. Fortunately, because of AI, the telecommunication companies, or else what you call mobile network operators, are actually looking at your behaviors at the back on the other side. For those who pay, you find someone with the same mobile phone, if you sit around and check, can access up to 500,000. Someone who doesn't borrow on the digital platform often and doesn't also pay may not access even 5,000. Recently, a friend of mine checked mine, and because I never borrowed on that digital platform, he said you can only get up to 10,000. Then I said it's useless. I will not even do it again. But there are other people who I understand can get up to about 500,000, which is about slightly about 100 pounds if you want to take it in terms of the pound, slightly more than $150. So that tells you that, yeah, there's the possibility of making your behaviors on the financial system as a collateral. That deals with more to do with information asymmetry. And if you provide more information about yourself, your rating will definitely improve. Let me go to the question and begin with the one from Dr. Riem. I'll try to go through them quite fast, moderator. One is the issue of access as a proxy. Yeah, we look through the financial capability survey data, and we try to probe to find which proxy would be the best to tell us whether the policy is actually taking an effect. And to the best of what we could get at that time, or during the study period, we thought actually access would provide a better option, because access means someone is aware. Access means there's room provided for one to participate, and therefore could actually provide. And that ties in with the rest of the question that people have been saying. So now that we've picked one proxy, we couldn't go into to investigating the impact of each of the other policies, including the guideline that we provided as Bank of Uganda in 2009. We couldn't investigate them. There are subsequent policies that came in place until on our side, the regulator, there's also the National Financial, the National Payment Act and then regulation as well that came in place much later. So we couldn't pick any of them. So because we are using a cross-section data, we needed something that tallies with the cross-section data. And therefore, we thought as policies improve, awareness improve, and therefore access improve. And that creates some element of correlation between those variables. But definitely, the best way to go around this would be to now do a panel study. Because a panel study, especially using FinScope, gives us data across a long period of time. We did FinScope in 2006. We've done the last one in 2023. So you have 2 or 3 other FinScope in the middle, 2009, 2016, and so forth, that can actually provide you more insights, and that could help us address that. In terms of the estimation techniques, maximum likelihood on the treatment effect model, we thought it was a good way to also address the issue of endogeneity between the variables, because treatment effect models are not like the normal logit and profit model. They tend to already have an inbuilt system that can address the issue of endogeneity. And we thought using them and estimating with maximum likelihood would actually help us to get that. We'll definitely check whether, we cannot check, of course, all the variables, most of the variables are not normally distributed. As you know, we converted them and they are now binary variables based on the indicators that we created. But definitely we want to check whether if we estimate a logit on the second equation, we can actually get something different from that. I think that addresses most of the questions from Dr. Riem. Then Birhanga had a question on money lenders, and I think that ties in what you've just answered with Andreas, that money lenders are taking advantage of the platform of easy access to their customers. They are providing the service at their own risk. Nobody covers them. They are not like other supervised financial institutions. And they are using AI at the back to see your behavior. So if you have a good behavior, they'll learn more to you. If you don't, then you'll either be priced out or you get very little from that. And then there's a question from Kosim. I think this is also addressed up on which particular policy. So we don't pick any particular policy at this point, but what maybe we need to add on the paper is the trend of how policy has evolved over a period of time and put them in the appendix so that members can know that we've taken note of the policies, but we are taking a proxy on this. And probably if we are to work with my colleague and advance the study using a panel set of data sets based on the FinScope studies, then we can also now maybe can intervene that this policy came at this point in time. What was it? What is its impact on digital finance inclusion, and we move forward from that point. Okay. Daphne wanted the context of the Rwandan study in terms of Uganda, and I think it was responded to as well. And then you wanted the exact policy, and I think
you have also answered it.
Thank you.
Okay, thank you very much. This is a timely discussion, especially in our market that is more suboptimal, and it is important that we facilitate the development of optimal financial instruments that will increase financial inclusion. I want to thank Andreas and Nicholas for the insightful discussions, and my audience, thank you very much.
Thank you, thank you. Another round of applause to our panelists and our session chair. Please just come to the front for a group photo. Our next session is going to be an expert panel. We shall try and have it as targeted and as quick as possible, because we would also like to hear from the experts, and we would like to hear from you as well. So to our panel, thank you so much. Okay, as they depart the stage, ladies and gentlemen, please allow me to invite our expert panel. Okay, we're first going to have Mr. Peter Kagumya from the Bank of Uganda, National Payment Systems Department. Peter has over 20 years of central bank experience, and he's an advocate for digital financial inclusion and regulatory innovation. You're very welcome, Peter. Let's give him a round of applause as he gets to the stage. I know you're all a bit exhausted from sitting, but that is the tough part about academia. Our next panelist will be Mr. Stephen Mutana. Stephen is the Chief Strategy and Transformation Officer at MTN Uganda. He has 12 plus years in telecom and financial services, and he's also very passionate about technology's power to transform lives. Stephen, please, you're very welcome. Let's give him a round of applause. And our final expert is our host, Professor Okumu, the Dean School of Economics at Macquarie University. He's one of the driving forces behind such engagements, and we are very, very pleased to have him on the expert panel. Professor, please, you're very welcome. Seems I also forgot to, invite the session chair. Session chair is me, Ralph, your MC. So this is also where you clap for me, welcome me. Thank you. So as I said, we are going to ask targeted questions. We want to hear from you, we want to learn from you. So Peter, I'm going to start with you. We have seen, from these discussions that policy is where, politics meet reality. Okay, this is what we have seen. But governments in East Africa are under pressure, to modernize payments, expand inclusion, and generate revenue all at the same time. The challenge is how to strike the right balance. So my main question to you would be, how can governance in East Africa design adaptive digital finance policies that strike the right balance between taxation, financial inclusion, and macroeconomic stability, especially in light of remittance flows, infrastructure gaps, and the gender-rural disparities that we may have? Over to you, Peter.
Thank you, Ralph, and thank you for this invitation. That was quite a mouthful of a question, but I think it speaks to the regulatory approach to embracing digital payment systems. And I think Nicholas was the one who was, in his paper, was talking about how the first guideline in 2009 was to MTN. We didn't have a law, but we had a guideline. And it took another 11 years for us to get the National Payments Act in 2020. That long period was one of the things that disturbed the progressiveness of how to strike a balance between all of these intricate payment systems, remittances, and everything. But even then we get to the National Act, which I must say, there's a paradigm shift, particularly from Bank of Uganda, for instance, where we are taking on more adaptive regulatory approaches. We are embracing guidelines that and policies, internal research and everything that make sure that we are tackling every digital payment system and ensuring that we are mapping it with rules. We are looking at the CDCs coming on board, we'll make rules for it. We're looking at a national switch coming on, we're making sure that we have rules or schemas for all players. We're not going to make it only for the banks, we're going to make it for everybody who is a player in the fintech space. You know, we look at open banking and open finance policies, which are things that are smearing under the, you know, still in the office, but we are going to make sure that these things are addressed and brought to the public. But the most important thing now that we do is that we make sure that sovereign currency, that is our normal money, we make sure we have rules for all payment systems that are being developed, that people are innovating. But that doesn't allow us not to look at the private currencies. I think everybody knows about these digital cryptocurrencies and everything. They are becoming a problem, but we have to kind of think about it. So we're on the lookout, we are looking at them cautiously. And so those are some of the things that we do. So we make sure we have adaptive regulatory frameworks for every innovation that we have. And their main goal is to manage risk. We must manage risk for all people. We must ensure that the fintechs are collaborating. We must make sure we have governance structures for these fintechs. I do not want us, let me make it more clear. A fintech that is a briefcase company, we shall not allow. You must be with people who understand, who can debate about the impacts for financial stability or for macroeconomics, like what we're doing here, what we're discussing. So we're making sure we have quality people managing these fintechs, managing these corporations who are in the innovation space, right? And then after all of that is done, so we have to promote responsible innovations. And I think one of the outcomes for that has been the sandbox. Right now, what we have is only the regulatory sandbox for payment systems, but we are aware insurance has to be there. We have other sectors, and I think we need to have some level of collaboration with all other financial sectors so that we probably maybe expand the sandbox to include all areas of payment systems. Thank you very much, Rob.
Thank you for that. Let me just build up on that. You spoke about, you know, regulatory sandbox. You also spoke about fintechs in the system. We have seen that the level of innovation is usually much faster than the level of regulation. And you know, people come up with ideas first, then the central bank comes up to provide regulations and guidelines. Is it possible that central banks or even other regulators are on the back foot now and we have to play catch up?
I think that is true. We'll always play catch up. But how are we catching up? I think we are much faster now. The example of MTN, 2009 and 2020. But right now, we have things like the virtual assets bill, which is being proposed by stakeholders. We are much faster now, today, because we have a central bank that is, you know, forward-looking. And this applies to all the central banks in East Africa. We are all forward-looking. And I think that's a good thing for our country. But for now, it's always a catch-up. But even when you're catching up, we allow the discussion to go on. And how are we doing it? Is through the sandbox. Those guys come to us, we have this discussion in the sandbox, you will know what is too new, what is too behind, and from there, we gather information, and then we start all of these feasibility studies that we are trying to do so that we can catch up as much as possible.
Thank you for that one. Now we're going to go to the practitioner, MTN. Stephen, innovation doesn't happen in theory. You know, it happens on the ground with us, the users. And I don't think anyone understands that more than mobile money operators or telecoms. But with transaction costs, infrastructure constraints, and competition for all your services, how best do we innovate for scale and inclusion? And then maybe to put that further, what innovations and industry practices have proven most effective in reducing transaction costs, you know, enhancing the user experience, and expanding digital payment adoption. You know, we're trying to get more people into using digital payment and digital financial services. So mostly among the vulnerable and remote populations, what industry and new innovations practices have proven most effective in reducing transaction costs and enhancing the user experience?
Thank you very much. Yeah, no. I want to face the audience. Thank you very much, and thank you for having us here and the deliberations since this morning, and obviously the work, the research that has gone into this. We truly appreciate it, and we're more enlightened by what we've picked up today. Now, in the practitioner's world, or the real world as you've stated it, we are here to solve problems. So we're driven, in every organization, everyone tries to find their purpose. We're driven by one belief that everyone deserves the benefits of a modern connected life. They may look like very simple words, but they stretch us to the limit. I'll give you an example. You know, you asked about, say, vulnerable populations or those that are remote. That can mean many things to many people. So for instance, we know we have one of the youngest populations in the world. We know that most of these young people, when they're hitting 18, 20, over the past few years, you've seen them go to certain parts of the world to do entry-level jobs, you know, in the Middle East, UAE, Qatar, Saudi Arabia. Now, if you put yourself in the life of that person, some of them spend 4 years before coming back home. Others, maybe 3 years. And in terms of gender, a big number of these are women, you know, they're girls. Now, they are young people, but they're literally breadwinners. They have to send money back periodically. They're paying school fees, they're supporting homes, they're supporting their parents, they're building businesses or setting up businesses. So now, when we talk of something like remittance or cross-border flows, inflows, now you're talking about, you know, what's the cost of doing that? What's the friction moving that? What is the safety that they have, that the money will reach the intended audience and be used for the purpose that it's meant to be used? So we now bring in things like remittance. And especially after COVID, most of this remittance became digitized. Before COVID, you'd go to a brick and mortar, you know, MoneyGram or the yellow one, what was the yellow one? Western Union, to pick the funds. Suddenly, you notice during COVID and after, the funds actually terminated onto the wallet. So at the back of that, there is a lot going on, as Peter, you know, talked about. How do you solve for, you know, the safety, you know, if this is cross-border, the AML, the CFT, you know, countering financing of terrorism? How do you make sure that as much of that money gets to this, the intended party? So that is inflow, remittance. Now, we had to open up a lot of corridors, talking to empathetic design. So we got many partners, you know, and these people, these corridors follow the money. So they follow where the people are. So we have sizable populations in, I think in Dubai, you have 100,000 Ugandans. South Africa, another sizable population. You have partners like Mama Money in South Africa. You have, in Dubai, you have quite a number of other partners that have grown with us since COVID. Those are inflows. Now, there's also outflows. Outflows could be people paying fees, people paying businesses, they're paying charges, say, at the ports in Mombasa. So going back to your issue of transaction costs, it used to be, and this was, I think it was December 20th, 2023, when this happened, where the P2P, peer-to-peer costs between, say, MTN and Airtel literally fell by literally, I think, over 50%, 50, 60%. And that also meant that even P2P across borders, which is now outbound remittance, went down to 1,000 shillings. I think 1,000 shillings at that time. Now I think the maximum is 2,000 shillings. So all this is in response to what people are asking for, or the pressure points. Circles where people come together to achieve common goods. They could be farmers, they could be students, they could be workers at an institution, come together for a common good. Such propositions or such products, we make sure that we encourage savings. So for instance, we found out one thing. If somebody is saving 100 shillings, they want to see 100 shillings. They don't want it to be 98 or 97. So for instance, for such situations, the circles that collect are not charged. The members that are putting in the money are charged a small amount. All this is response to what the customers are looking out for. Then maybe very quickly, everyone invest, if you look at our savings, per capita, they're actually very low in the East African region and globally. And yet people want safety. This safety can come in form of savings, can come in form of investments, can be insurance. So there are many things. For instance, recently we did a mass market unit trust, e-investor, where for as low as 1,000 shillings, you can actually get daily interest on that. Now we do that because it's one thing answering the credit needs of people, but it's also important they also understand that when you borrow, you must actually save as well. You drive both behaviors. So, and if you look at that particular product, anything coming in or going out is free, okay? And that's how it has been designed, because again, if somebody is saving and whatever they're saving is instantly reduced, they won't save. They won't move from the physical savings. It could be chicken, cows, goats, or even cash into this digital form. So there are quite a number of, don't want to take too much.
No, because first off, congratulations on the launch of Investor. That was, Peter was, very, very excited about that. So please pass on our congratulations as well. But that brings me to my question as a practitioner. We've been talking about digital payment systems and how to, make them better, how to make them cheaper for people. As a multi-billion-dollar company, MTN, how do you balance business sustainability with the need to drive inclusion at the bottom of the pyramid? You have, yes, products like Investor. You have, very agents, all over the place. Mobile money, your network is all over the place. People are able to. But speaking as, part of EXCO, do you see a situation where it's possible to drive profitability while also looking after sustainability of especially what we call the lower income groups?
No, thank you for that. Maybe a few years ago, that would have been an either-or question. It's now an and question. You have to drive both. Now, this morning when I came in, one of the professor over there was presenting a very interesting paper on the double-edged aspect of interoperability versus, and how the prices fall versus what you'd call the benefits of the ecosystem, like coverage or the rails. Now, if we look at the industry in Uganda, I think it was over 10 years ago, and thank you, Professor, in his model, he was showing you that the mobile money we have in Uganda today is based off a SIM card. So you have the SIM card, which is the mobile net telecommunications provider, and then mobile money service sits on top of the SIM card. So we use services like SMS, USSD, which are relevant for our market. But I'll also talk about apps later on. But anyway, back to your question about sustainability and business. 10 years ago, each of us, the two players, okay, we're many players then, but the two major players, we all used to run our own sites. okay? Then we decided it wasn't sustainable to do that, given the fact that for us to scale these services, we needed to deliver more value. And value to a customer means I'm getting the same utility at a lower price, okay? And of course, there are other things beyond price which give us value. So we then sold these towers, okay? That was 10 years ago. You would be interested to know that 4 weeks ago, we made an announcement, both MTN and Airtel, we're now going to even share network. The actual network layer is going to be shared. Why do we do that? We're actually extending this issue of cost. The issue now should be, how can I reach that customer with the right service at the most appropriate cost? And we now, if we share that cost, we then bring it lower, meaning we become more relevant or sustainable, as we want to say. So we do this, and I gave cost as one example, but the other bit which Nick talked about is trust. Whatever we do, if people are losing their money, their value, their investments, their savings, they will lose faith and trust in the ecosystem. So with sustainability, you now talk about, you know, the cybersecurity, you talk about the risk management, the compliance, because as you scale, more is expected, and then people have faith in you for the range of services they're using.
Thank you very much for that. Professor Okumu, our host. I know you usually at the other side asking questions to students, but now it's your turn. What are the key research insights and evidence-based recommendations that you believe will inform the next generation of digital financial policies, market innovations in East Africa? We've gone through, you know, what is on the ground right now, but as a researcher, as an academic, someone who's, you know, looking forward, what are the key insights and recommendations that you would actually point out to inform next generation of digital financial policies?
Thank you very much, Raf. Once again, my name is Ibrahim Okumu, and first of all, thanks to the presenters of the day. For me, what came out strongly is the fact that policy is no longer a gamble. We had a paper presented this morning about the failure of OTT, which is the over-the-top tax that was instituted on social media. Clearly, what came through was that this was an off-the-cuff policy that was adopted, and it failed. Now, the lessons that come through is that where possible, it is important that we leverage the capacities that each one of the East African countries has in terms of testing policies. At least here, we have grown capacity in experiments, you know, lab in the field experiments. This gives us the leverage to learn the potential impacts that a policy could have before it's taken to the market. I think for me, substantively, that is important. Secondly, what has come through for me is the fact that it might be difficult for regulation to catch up with innovation. Innovation will always be ahead, but what is important is that the environment should never curtail innovation. Rather, regulation should try as much as possible to organize the market so as to get rid of the potential market failures that could result from the innovations that have come forth. Thank you.
I would like to go much deeper into that. And this is a cross-cutting to all of you. What is one innovation or reform you believe is critical for building a resilient digital finance ecosystem? What is that one innovation or reform or policy you believe we may be lacking now in building a resilient digital financial ecosystem in Africa?
I think, I will look at this university and the private sector. Where I'm coming from, the missing link could be the private sector engagement with universities. Look at, for instance, MTN. I've listened to a value chain of innovations that my colleague has shared with us, and I'm asking myself, who is undertaking the impact evaluations here? So from where I sit, I think MTN is missing something. You are welcome to the School of Economics. I can give an MTN professorship so that we can advance research in these spaces. We can set up an MTN lab wherein we can advance research within digital financing. So for me, what that would do is that we would better match products with the nature of the market that we have. But most importantly is that what research gives you is the element of feedback. Now, it's from that feedback that we can better calibrate the products in the digital market that, again, are much more suitable to the market. But most fundamentally, the private sector is missing out on the PhD programs that we have. They need to come on board and influence the nature of research, the nature of research products that they need. Now, one way of doing that is by financing PhDs, say in economics, and with that, we can continue to be relevant to them. Thank you.
Oh, good. Same question.
Thank you. I think in line with what Professor said, from a regulatory point of view, I would like to take it that we need to have more collaborations with incubators. And a university like this, and this program that we're having is a very perfect example of how you can set up incubators where the real innovators and the researchers can work together to get a product to a sandbox, which is a controlled environment for testing. Then that product can go to the market. Once you have that synergy, you will actually have products that will last, that will be meaningful for everybody, and whose regulation will even be easy. Because Professor Kumu is not going to tell an innovator do something that is going to bypass the tax laws or going to bypass any other laws, for instance. So I think a university should take up the lead in having hubs, innovation hubs, where you can incubate all these innovations in the digital space. And that would lead to applications, better quality applications to sandboxes, which also should be maybe all-encompassing. And then we'll have better products for Ugandans and East Africans altogether. Thank you.
Thank you, Peter. Steven, same question.
Thank you. Thank you very much. And thank you to the two contributors. I think immediately for the mobile money sector, mobile financial sector, I think it would be a robust approach to taxation, for growth and transformation industries, if I can use that loosely. As Prof mentioned at the beginning, where we bring policies in place that are based on a medium to long-term view for critical transformative industries or sectors of the economy. So specifically, I'm talking about the approach, say, to tax, like the 0.5% tax on withdrawals, and the impact thereof on the wider goals of economic growth, financial inclusion, and the sustainability of emerging segments of society, be they small businesses or individuals. So for me, a robust approach to such critical aspects.
Okay, I noticed, Stephen, you didn't respond to Professor's invitation for you to do a PhD at the School of Economics.
You know, Professor, thank you very much. MTN has a long-established tradition of collaborating with universities, and this particular university. I know when we were setting up and there was a shortage of skills, engineering, IT skills, literally we had a graduate program. Our first graduate program for many years was with Macquarie. And I know over the years has expanded to other universities, specifically around ICT. I think there's a huge investment in ICT for 4 universities, which is part of the MTN Foundation. Professor, I truly hear you for the things that are crucial to taking us forward in digital finance. We should actually collaborate with you, the institutions that build knowledge, that test knowledge and curate it in new ways that actually catalyze the development of our sectors. So I have written it down at this stage. Thank you.
Okay, final questions for my panel here. I'll start with Peter. What are we not looking at in terms of regulation looking forward? What are the black spots that you possibly want us, that you would advise researchers, the private sector, even policymakers such as yourself? What are the blind spots that we are not looking at that you believe will actually could become crises in the future if they are not taken care of now?
Thank you. Good one. If you think ahead, I'll probably say 2 areas. One, due to the technological advancements that we are seeing, we're having a lot of private innovations in the currency space. So there's the Bitcoins and everything. That is definitely a blind spot for us. Accompanying that is the fact that we do not have proper governance structures for innovators. So these innovators, like I said earlier, you come and the guy has a briefcase and he's telling you he can do magic. And once he does the magic, tomorrow when he or she is away, then the whole program is closed. You need to sit down and we teach our members who are coming up with innovations that even the governance of the entity must be bespoke. It must be good. It must follow the rules so that the taxman can come when he comes or she comes. This is what we need as a regulator, that before you come in and show us your innovation or want to apply for a certain product, that you have both the technological side in line and you have your governance structures in line. We are finding a lot of governance structure issues lacking for many people. I mean, you create a company and you're the director, your child is the director, and the houseboy, your house girl is. No, that is not right. And if we continue in that direction, we are going to have very difficult conversations with people going ahead. So I think for me, governance and how to capture the more advanced technology, which is upon which financial innovations are being built, and that is just basically the cryptocurrencies. Those are the 2 areas that I find difficult. Thank you.
Prof, your final question is, we've already spoken to it about the need for synergies. And that would have answered my question, that is the current level, partnership between public and private, is it enough? It clearly is not yet at the level you'd want it to reach. So this might be a bit academic, but how do we create stronger feedback loops between policy design, real-time user data, and academic research to better drive financial inclusion?
First of all, this is a good start, and the relevance of academia is in the fact that it has to be attracted in some of these spaces. Now, it's such spaces that your value can be identified and in the process sought after. And so for as long as we continue to have such engagements, I think it's one of those ways of closing gaps. You know, it's one thing for Okumu to have a paper, present it among his colleagues at the School of Economics. He receives academic criticisms of the paper, and then you publish in a top or mid-tier journal, you are happy. But without testing the idea within the practitioners, the likes of Stephen, you can never be in a position to appreciate the context better, you know. And the feedback effect is that as you're appreciating the context better, you're tuning the paper to fit the environment that Stephen, the practitioner, is much more used to. Now, by doing so, you are basically creating relevance. Now, that is where we can strengthen synergies to the extent that the private sector can value what we are doing, and we can at the same time value and consequently be of value addition to the private sector. And indeed, through engagements of the kind, it's possible that MTN can come on board and say, I'm going to give money for MTN professorship. And the professorship could be to the extent that you assign funds towards research within the space of digital financing. Or it could be the case that MTN or Airtel could actually put up funds for a digital lab to the extent that any subsequent PhDs should be within the space of digital financing. Now, that's only if academia has created value. Thank you.
Thank you. To Stephen, final one. We've heard from Peter where the blind spots are. We've heard from Professor where he can see a linkage and where he sees people, partnerships and people coming in. From you now as a practitioner, someone as the regulated, where do regulatory constraints currently limit your innovation or generally innovation in the current situation? And do you believe collaborative sandboxes or collaborative partnerships and synergies, like Professor said, are the best way? So what I'm really trying to ask, how are we failing you? How is BAU as a regulator failing you as an innovator to help you move forward?
Thank you very much. So, at the heart of fintechs, and I'll speak about MTN, mobile money, is that we can't do everything. We need partners because we don't have all the knowledge. We don't have all the insights that Professor was talking about. What we do promise is that we have the culture, we have the platform that enables different orchestrators, obviously under the ambit of the compliance framework, to be able to deliver value that is relevant to customers. Now, a lot of the services or the products that you consume are not necessarily done by MTN or by Airtel, but we have partnerships. I gave examples of remittance. The example of Investor, the unit trust, is with Sanla, So we are platforms. Now, because you're a platform, it means a lot of people have access to you, and by extension, you have impact on so many facets of life for people. It's around, say, payments. It's around people being able to get credit or loans. It's around people being able to collect through circles and that kind of thing. It's around people being able to get access to either cash or be able to transform it into e-value. Or it's even people being able to pay school fees, hospital, insurance, people being able to send money to somebody, you know, at a distance. So with that great responsibility, you know, you really need to understand that the regulator and other stakeholders are not really an obstacle, okay? Because with size comes responsibility, you know, with size comes responsibility. So, you know, as Peter mentioned, and he gave the reality, is that if you're going to come to the regulator with this amazing idea, he's going to look at two very big pieces, first and foremost. What is your governance? Are you able to be sustainable? Because you are doing things in trust or on behalf of other people or offering these services. We all know how many, and I don't want to mention organizations that have disappeared with people's savings. Be they, invest in chicken, invest in this and that, and then they disappear overnight, and then you get people coming to the authorities saying, but I lost my savings. Those are the things that the regulator is trying to prevent from happening, because they then have long-term impact on the ability of people to trust these systems or financial systems, and you know, the ability of people to move into digital finance. They just say, oh, those are thieves. I have met a number of victims of fraud who then say, oh my God, I would never use that service again. I lost my money. It's because of the trauma. So in a nutshell, the regulator, key stakeholders like, you know, academia, other, you know, you look at the FIA, for instance, yes? All those are there because we've learned from something and we're applying those learnings today. So I think, especially for fintechs, there's no way we continue disrupting without the knowledge. Yesterday I was talking to a fintech that was saying, listen, with Gen AI, we can now, actually they were saying that they're developing a Gen AI model for Uganda. So that, and they were telling me about it, and I was telling them immediately, I think I have a use for that. Why? There's so many products that are launched, but if I walk on the street and I ask somebody, how can you make more money from your savings on MTN? Or how can you reduce your cost of transaction? They wouldn't know, but they would only know the services they use. So I would like to use that Gen AI capability, which is obviously based on knowledge. I mean, AI, 1950s, the first papers in universities, and now we're just bringing them into the mainstream, the capabilities. I would use it for education, consumer protection, consumer awareness. Because I send SMSs today, people don't read them. You're on radio, they have too much to listen to. I need people's attention. So if somebody can actually talk to a medium and say, listen, this is the problem I have, how do I solve it? And this is Gen AI at the back, and it's speaking back to them in their language, say in Uganda, then I'm increasing inclusion and relevance.
Well, thank you very much, my esteemed panel. Thank you, our audience. I would like to bring this to a close. I believe there are some questions though. So, please raise your hands. Sam, where is Sam? Please get the microphone and help us move it around. Sam isn't here. Okay, if you can project, you can stand up and ask your question. Sam, can you please help us get the microphone and we'll move it around? Thank you. Please remember to introduce yourself and to who on the panel you're addressing the question to.
Thank you for the opportunity. Msinguzi Emmanuel is my name, and I'm from Mitro Plus Labs. My question goes to Mr. Peter from Bank of Uganda. Based on the technologies that have moved on, the cryptocurrencies, due to the the high cost of transaction in Uganda, people have now moved on to use of the bitcoins that are of at around 75% lower than the current transaction, the digital payment systems in Uganda. What has Bank of Uganda done to so far to regulate? Because they have not said anything yet. We are curious, and as technology enthusiasts, already there are currencies that have developed up in Uganda, but Bank of Uganda has not yet come out to say anything yet. So I was inquiring for more information about that. And my other question goes to the professor, is that I'm a student here, but the education of digital currencies has not been strengthened in the university. We are requesting for at least to put more attention on this digital payment system education in our university. Thank you.
Thank you very much. Next question.
Well, thank you so much. My name is Edwin Wampamba. I'm a student doing Masters of Arts in Economics. My question goes to Mr. Steven of MTN. And my question is, we have a lot of digital payment platforms of MTN, like mobile money. How has MTN used them to reduce the informal economy? And maybe how can it still use them to enhance the fiscal planning policy of the country? Thank you.
Thank you. We have a question right here at the front.
Thank you very much. I'm Zima Gislain from BOU. I have two questions to Mr. Steven. The first one is, you talked about the network share between MTN Uganda and Airtel Uganda. Is that a response to the new players coming to the market, such as Starlink? And then related to that as well, with the coming of Starlink, will that mean that you will not need cell towers as much, and as a result, reverse the issues that come with interoperability? I don't know whether that question makes sense, but I hope it does. And finally, would you, okay, I do not feel like banks have learned from money on us. For example, banks still charge you an account maintenance fee, and MTN does not charge that, or Airtel. Why do you think is preventing commercial banks from being much faster in adopting these new ways of dealing with e-money? Thank you.
Thank you very much. Do we have any more questions? Let's take these final two. Well, it's him and the gentleman over here and at the back, please.
Hi, yeah, this is Andrew again from the IGC. So I just had a couple of questions for Steven. So in terms of cross-border use of mobile money, are you at MTN seeing any developments beyond the use of remittances? Is MTN interested in trying to get more involved in cross-border trade? Maybe not explicitly, but maybe trying to partner with other mobile money companies, or partnering with other, MTN in another country to try and facilitate trade rather than remittances, which is the dominant use. And what was the second question? Yes. So there has also been the development of the escrow accounts, so mobile money or interest-bearing mobile money accounts. So I just wonder, is that changed the business model or opportunities for MTN, and anything from the research community that could be helpful in that domain? Thank you.
My name is Jonathan Baloja, year 2, student of science and bachelor's in population studies. So my question goes to Professor. So how will the incubation research labs relevant in the nation, or is it really necessary to generalize the content we get from the incubation research labs to the entire nation? How will they factor in everyone, considering their background and the context where they live? Thank you.
Our final question at the back. No, sorry, the lady at the back, please.
All right, thank you. My name is Joshua from BOU. Up to Professor Okumo. Would an industry-sponsored curriculum, for example, the teaching professorship,
Sorry.
What's the question again?
Question and name again.
What's the question again?
how would an industry-sponsored curriculum look like? For example, the teaching professorship you mentioned in your presentation. Thank you.
Okay. A final question from the lady at the back.
Thank you very much for the presentation. My question goes to Mr. Steven from MTN, and what I would love to know about the digital payment systems is in regards to the transactional cost. You find that the magnitude is much higher on low-income earners when withdrawing the money than on people who have more money on the mobile money. If you're withdrawing 5 million, with the costs you incur are much less according to the money you have there, and compared to, let me say, when you have 100,000, you incur much more cost in terms of magnitude. And since this is about inclusivity, given that most of our population basically is in agriculture, or it has low incomes and living below some poverty lines, I believe most of our population transacts within those with the low incomes. That means they incur a very high cost. So what strategies are there to improve on to make sure that the costs become less for such people in order to encourage inclusivity for not only for those farmers or someone out there, but even for students. For example, for me, if I'm going to withdraw money, if the cost is about, if it's 100, sometimes it's in rates from 100 to, let me say, from 100,000 to 200,000, there is usually a cost. But when you try to compute how much you're going to lose by, let me say, withdrawing in bits, it is not very feasible. So yeah, my question is, how are the transactional costs going to be better for inclusivity for the low-income earners? Thank you.
Right, thank you all for those questions. We'll put these experts, let's just let them show now why they're called experts. We'll start with you, Peter, then followed by Stephen, and Prof will take us home.
Thank you. I think I had one question from Emma. We'll go straight to it. Cryptos. By way of context, let me tell you this short story. There is a project called mBridge, which is dealing with distributed ledger technologies. And there is a test, they're in a pilot test between Saudi Arabia and China. So they made a payment, very big deal, trade payment, and indeed, the cross-border fees were drastically, and no, I think it should be significantly reduced. So as a technology, it is okay. But what those two guys did was they used the CBDC, which is a central bank digital currency. They didn't use a cryptocurrency. The difference between these two, and yet they are working on the same system, a similar system, which is a distributed ledger, is that the CBDC, you know who the owner is. and you know yourself. Governance. What Stephen talked about earlier, you know governance issues are okay. And so once you know the legality of both sides, you have inevitably created trust. So there is cross-border payments and distributed ledger technology, significant cost reduction. In cryptos, the difference is that you only know one side. You, Emma, we know you, but you don't know the crypto guy. There is no governance structure for the crypto guy. So there is guidance from Ministry of Finance and Bank of Uganda, 2022, which is saying that all supervised financial institutions, including money issuers, electronic money issuers, not to engage in cryptocurrencies because we cannot guarantee the governance of the other side. And that guidance remains till today. Don't engage in things where you only know half the story. I think that should be very clear to you. If you're a student, it's good we are aware that these technologies are there and everything, but knowing one side is not good enough. From a regulatory point of view, we need to know both sides. I thank you. I think my colleagues will answer the rest of the questions.
Stephen?
Thank you very much. So I'll respond to these questions broadly in sense that I'm mobile money, but I'll speak on the MTN side as well, which is the voice and data. So I think I'll start with Edwin's question. There's a gentleman called Edwin. He asked, how has MTN utilized digital platforms for the informal economy? I think from the get-go, when mobile money was launched, even at its most basic, which was cash in, then send to somebody, or cash out. That in itself, up to today, close to 65% of all transactions are just that, okay? I was looking at M-Pesa, Kenya, their 6-month results to September last year. Even with all the developments in Kenya with M-Pesa, still 60% of their service revenue, or their revenue, is from that basic bit. So when I say basic, people are transferring value to each other or they're cashing it out. What does that mean? It means that, and I think Professor alluded to this, you solve a problem to the level it exists within your society. So what I mean there is that the need for money to move, velocity, value to move from one part of the country to another, from one parcel to another, for whatever reason, is still a very useful need, or a top-tier need. So in summary, what you see in MTN Mobile Money today is fueling the informal and the formal economy. But specifically, we've also evolved things like the digital credit. You've seen products for 1 month, you can borrow for 1 month, but you've also noticed we've got approval to launch products which you can determine how long you want to borrow the money for. Is it 2 days, 3 days, 4 days, 5 days? All that is because you are picking the feedback from the customers. In fact, I'll tell you this, I've just remembered. During the lockdowns, remember we had the 3-month lockdown, and then after that, another 3 months, mobile money revenue dropped. What that tells you is that a lot of the mobile money transactions that as many billions of transactions as they are due to daily sustenance. People earning daily and then saying, oh, send this to my mother, or I'm paying for this or that. It's daily. So it just goes to show you that it's still in tandem or in touch with that informal economy. Okay. So, and there have been a number of other services around device financing. Again, this was launched during COVID, where you assess somebody's behavior, and then you give them a smartphone or a smart feature phone, and then they can pay every day, every week, or every month after paying a certain deposit. we've distributed close to 300,000, over 200,000 of these phones, and the people do pay back. Yes, you do get some of those who don't, but overall, it's a measure of the quality of the people you're selecting. So all that. There was something about planning, but I think I've lost it from the same gentleman. But there was a gentleman in the suit who asked about Starlink low Earth satellites, which essentially is there are these low Earth satellites that can now, over a wide area, provide broadband. So today, you know that for you to get a signal, you must have a cell tower that you're looking at or within your vicinity. Now the technology has, well, satellite was an older technology. They've actually just revamped it, where you can now hit an area. DSTV is an example. You do get entertainment over satellite. So now we can now get better speeds of or broadband over satellite. Now, one of the use cases, the most obvious use case for that would be in the hard to reach rural areas. But we do know that the proponents of low Earth orbit satellites, and there are other orbit satellites as well that provide broadband, and you're going to see many of them come up, by the way. The Chinese have also got their own play. You've seen Elon Musk's play. They also want to come into the urban areas. So I think it's more, at this point, a regulatory question. Where do they play? How are they licensed? Okay. Remember, somebody talked about over the top. You must avoid being an over the top business that sits on top of other people, you know? So if you're going to play in the broadband space, where people are paying hundreds of millions of dollars for a license, then, you know, these are some of the things that regulators have to take cognizance of. So, but overall, it's good. It's good that there are alternatives, that there's competition, that there's disruption, there's progress. Yes, it makes me get gray hairs much faster because, you know, the competitive landscape changes, but that's the nature of business. But again, ultimately, the customer will always choose what gives them value. So it's a very interesting development. The gentleman asked me about cross-border trade. Cross-border flows. Trade would be one of the first sticky points or one of the key use cases for cross-border flows. One of the associations I closely support, and I support them for a very selfish reason because I keep very close to them and I get to know what their issues are. I found out that there was some of the biggest users of sending money to Kenya. It's like, I kind of asked them, but what is this all about? Then I found out they are the transporters who then move goods between Mombasa and Uganda, and they have to pay port fees, you know? So they send quite a lot of money using mobile money. So those are the things that grow propositions and services. So wider, you have the African Free Trade Area where you have to follow that money. And I remember I said we can't do everything by ourselves, so we have partners who we engage with in order to enable these business flows of currency between countries. You know, you have the likes of Flutterwave, you have so many other entities coming up in that space. Yes, but what we've also done, especially within East Africa, and very soon, we are doing our first interconnect with Vodacom Tanzania, where we won't have somebody in the middle. So two things, somebody, a customer from Vodacom Tanzania will be able to come to Uganda and pay at our Momo Pay merchants. The customer from Uganda will be able to go to Vodacom and also pay at their Momo Pay merchants, at the Voda merchants there. So this interoperability is evolving and happening. Sorry, the point on the escrow I didn't pick clearly, but I'm happy to pick it up later. The lady at the back, she says, and I think the presenter, the professor this morning did mention that the fees as a proportion of the value are usually more stringent on the smaller transactions and the bigger transactions. the professor put it up this morning. And essentially, you would call it the fast-moving consumer goods, approach to pricing, where your price per unit, is literally higher for the smaller units than the bigger quantities. That whole thing of, economic quantity, order size, and all that. But does that mean we're going to be hostage to that? No. What we do, and I think the previous presenter, Nick talked about it, with AI and analytics, we're actually able to pick up some of these situations. So you'll find that, for instance, for the telecommunication business, we have regional pricing. The prices are not the same everywhere. So there are certain regions in this country where the bundles, internet bundles, are cheaper than other regions. And the reason for that is that you're trying to grow accessibility and awareness. And hopefully for services like mobile money, we're going to move into that kind of evolution, where you just don't do one size fits all. You're able to pick up the feedback from customers, and you're then able to take a position which encourages them to use while growing revenue. But beyond revenue, the most important thing is you're actually trying to bring everyone into usage or inclusion, as you pointed out. Then the other bit, lastly, I'll just say this: even when it is a price per unit, we put a cap on some of these things. You can't have it go on, be too. So, for instance, if the big unit is, say, maybe working out at a 3%, and the small unit is at a 6%, you can't have it get into 10%, 11, 12. You cap it at some point, so that there's fairness.
Thank you, Professor.
Thank you very much, MC. I had 3 questions. The last one was the operationalization of the chairship, right? And yes, thank you very much. How that works out, I'll give an example of, say, the Mtebule chair of monetary and financial economics. How that would operate, our thinking was that the central bank would set aside funds at the School of Economics, and what the funds would do would say you would attract Lorenzo from Italy. He sits at the School of Economics for a year, and in the process, he will be churning out research papers within the space of monetary and financial economics. And of course, outputs of this kind are outputs that, one, are relevant to the image of the School of Economics, but most importantly, it's an output that's relevant to the central bank. Now, in my explanation, I used MTN and or the private sector, so to speak. So if it's a chair for the private sector, then it would mean that you set aside a fund that would attract human resources to undertake research within the private sector. And that could even extend to nurturing local capacities or even giving seminars within those spaces. The other question that came through was from Jonathan regarding incubation labs and the ability to capture cross-border or the different skill sets. My understanding of a lab, is to the extent that depending on the product that's being developed, different products have different nodes of skill interest. Now, because of that, what that means is that you might need to have different players come into the same room and develop the product. I'll give a case. We are developing sensors, and this is being sponsored by the Ministry of Science and Technology. We've had over 4 meetings, but it's an engagement of different persons. You have people from agriculture, economics, medicine, engineering, among others. So the point I'm trying to make is that different products will have different skill requirements, and as and when a skill is required, it will be sought for. Then lastly it was about digital currencies and the extent to which they are being incorporated in the university curriculum. Let me emphasize that there is no university program that can be approved without a stakeholder engagement workshop. So it's during that time of stakeholder engagement that we expect input from stakeholders. And in the event a business program, an economics program is not sensitive to the digital environment, then that ought to be pointed out for purposes of inclusivity to the extent of taking care of the digital developments. Thank you.
All right. Thank you very much. Can we please give a round of applause to this panel? Thank you so much. Thank you, Stephen. Thank you, Professor. Thank you, my colleague. Yes. So now we are going, us as the panel, we're going to have a group photo, but our last item will be closing remarks from Professor to see us off. So photographer, let's have the group photo.
Thank you, Mr. MC. And kindly allow me stand on the existing protocol. And these are the closing remarks. As we come to the close of this important conference on the macroeconomics of digital payments, allow me to extend my heartfelt appreciation to all of you who made this event a success. To our esteemed partners, the Bank of Uganda, the International Growth Center, thank you for your leadership, your trust, and for making this intellectual gathering possible. Your support has been instrumental in creating a platform where ideas, research, and policy can engage meaningfully. To our paper presenters and discussants, thank you for your rigorous contributions. The insights shared today have deepened our understanding of the evolving digital payment landscape and the macroeconomic implications that come with it. I am confident that these discussions will inform both ongoing research and practical policy making. To the participants from academia, government, the private sector, and international community, thank you for your engagement, questions, and contributions throughout the day. Once again, at Macquarie University School of Economics, we believe that events like this reflect what is possible when knowledge and partnership converge. As we look ahead, we remain committed to growing these collaborations, especially as we prepare to launch the Master of Science in Economic and Investment Modeling in August 2025, and as we seek to bring the African Econometric Society Conference to Uganda in 2027. We once again count on your support. Let this not be the end of the conversation. Instead, let it mark the beginning of a deeper engagement around research, innovation, and policy dialogue in Uganda. I wish you all safe travels, and I look forward to our continued partnership. Thank you very much for God and my country.
With that, ladies and gentlemen, we have come to the close on our dialogue on the macroeconomics of digital payment systems. I am not going to repeat what Professor has said, but thank you to all our presenters, to our panelists, to our guests, to our partners. Thank you all very much. We do have one final bit of business. We have a cup of coffee or tea, depending on your preference, as you step out. Have yourselves a good evening and safe travels home. My name is still Ralph. It hasn't changed from morning. Thank you for giving me your attention.